All right, this seems to be working better. Welcome to the Tennessee State Funding Board meeting for November 16th, 2022, at which we're going to hear from several different presenters in regard to the important task of revenue estimating, something we do every year in preparation for draft of the state budget. We're glad you're here. We'll recognize Senator Todd Gardenhire, who's here, I think, is right now the sole legislative representative in the. I'm overlooking somebody. And do also want to recognize the presence of my great predecessor, Justin P. Wilson, who must feel like he's at church. I notice he's in the back row. I do have to thank him for the loan of this necktie today, this rich necktie. Welcome, Commissioner Jim Bryson, your first time in the estimating process. Welcome, Mr. Secretary and Mr. Treasurer. Note the presence of a physical quorum. Unless there's any questions or comments, we'll jump right into the agenda. Ladies and gentlemen, we are going to power through this agenda today without a lunch break. I will note that we have snacks and drinks over here on the table. You're welcome to those just as anybody in the room is. We might take a 15-minute break at some point in time, but otherwise we're going to keep rolling today. Hearing no questions or comments, first on our agenda today, we're welcoming back Laurel Grafey, who's representing the Federal Reserve, and you are welcome and you are recognized. Welcome, Representative Rush Brickett, today. So you're recognized.
So much. It was always an honor to be able to participate in these conversations. So thank you again for the invitation to join. Cindy runs a very tight ship, and I've been given 10 minutes to talk about the entire economy. So I'm going to do my best to give a general high-level overview, but certainly welcome any discussion if it would be helpful to get into any detail. I was reflecting back on our conversations over the prior years, and I think every single time I start, my sense is my role in this discussion is to give a broad kind of national economic perspective, and then the gentlemen that follow me really get more focused on what's happening here in Tennessee. And I think every year up to this point, I have started with a picture of the Tennessee economy overall and how it maps to the US economy. In general, to tell the story that when you look at the industry breakdown, the employment breakdown, Tennessee tends to move roughly in tandem with how we see the national economy move. And certainly a lot of that is still true right now. And as I look at the past 2 years and look forward into the coming year, it seems really clear that the major drivers on a national perspective are absolutely going to be at play here in Tennessee. Whether you look at the impact of geopolitical events and what that means for energy costs and supply chain, weather disruptions, demographic changes, an aging population, older workers opting out of the workforce at a pace that we haven't seen since around 2008, 2009, the impact of the pandemic, all of those things are going to continue to be drivers of activity for us here locally as well. But I think unlike in prior years, we really are in a place where Tennessee is also being impacted by some trends here that are causing us to experience the economy right now in some ways that are really unique from the rest of the country. And so I wanted to touch on those a bit. One is just it is worth just stepping back and recognizing the incredible pace of demand over the past couple of years. And that's both in terms of demand from consumers for goods and services, demand from businesses for equipment, and for workers. I mean, it has just been remarkable and has resulted in the strongest employment we've ever seen in the state and the fastest growth in employment than we've seen in over a decade. And it really is quite remarkable what has brought us to this point. And certainly a lot of it has been driven by a massive pace of in-migration into the state. And fortunately, our economy has been growing at a pace we've been able to absorb those new workers, to put them to work and have really benefited from the fact that the folks coming into the state tend to be more highly educated. They tend to have higher savings, be ready to invest. And that's especially been helpful at a time when we're seeing Tennesseans opt into advanced education at a slower pace than we had been accustomed to. We've been benefiting, and certainly our employers have been benefiting from an in-migration of relatively higher skill workers. But of course, that strength comes with some challenges as well, as we've all experienced. And we know that inflation has been a big factor nationally over the past year. And I would say the pressures that are driving inflation in many ways have been especially acute for us here in Texas. When I think about what at its core drives inflation, it is a mismatch between supply and demand. On the supply side, from a goods perspective, there's pandemic disruptions, geopolitical disruptions, kind of other factors holding back supply. Certainly labor disruptions, folks opting out of the workforce, parents, especially parents of young children, having a lot more intermittent participation. So that's held supply down at the same time as demand has just been remarkably strong. I don't think I know of any mainstream economic forecasters who this time last year would have predicted that demand would have held up as strong as it has through today. And we know even this morning we got a report from US retail sales that consumer spending has just held up in a remarkable way. And so to some extent, as we look forward and think about balancing out inflation, it's a matter of how do we see demand and supply come back into balance? And at the Federal Reserve, where we are so focused, I don't think I've ever actually talked about monetary policy in these discussions, but I know that it is in play in a bigger way and is certainly impacting Tennesseans today, probably in a greater way than has been the case in many years. So the Federal Reserve's main policy tool, increasing interest rates, mostly impacts the demand side of the equation in making it more expensive for consumers and businesses to access credit and helping to dampen demand to try to bring it back into balance with supply. And I think the big question is, how far are we going to have to go? How much does demand need to be held back in order to bring inflation back to a point that feels like secure price stability? And one of the big question marks is, how much then can supply do the work? Does demand need to go all the way down to meet this lower level of supply? Or are we going to continue to see some alleviation in supply chains? We've seen some of that already. Are we going to continue to see workers flowing into the workforce to a greater degree, increasing productivity, supply continuing to come up to meet demand so that we don't have to continue to dampen that activity as much as it might otherwise be necessary? So interest rates now higher than they were over the past several years. They've been raised to a range just under 4%. And all expectations are that rate is going to need to continue to increase to be at a level that's sufficient to bring inflation back into balance. There certainly are a lot of us paying attention to how the economy is responding to that. Of course, the first portion of the economy to respond to rising interest rates is the residential real estate market. We've already seen that. But generally, the impact on other sectors of the economy, consumer demand, business demand for workers, those things all happen with a lag. Maybe I'll just touch, in the interest of time, quickly on the labor side of things. I'm moving to slide 11. There continues to be a huge mismatch in this country, and this is still the case in Tennessee, despite the fact that we have been fortunate to have a growing labor force in a way that many states have not because of the in-migration into the state. Continue to see a significant mismatch between the demand for workers and the supply of workers. And even with some recent moderation in demand, that mismatch is likely to still be in place. And I'll note that last week, the markets and the media made a really big to-do about consumer price inflation, CPI report that showed some moderation in the pace of inflation. As we looked into the data, it seemed like a lot of that optimism was a bit premature, in that much of the decline in inflation was actually being driven by sort of a methodological update in backward looking measures of health insurance costs. If you look at the actual core drivers of underlying inflation, there are still indications that, yeah, maybe on balance, things haven't gotten worse over the past month, but it doesn't seem like that pressure has alleviated significantly. And this is in particular as we look at this balance between goods and services. We've talked in this group, and certainly the state of Tennessee and many states across the country benefited during the pandemic from a budget perspective as consumers pulled back their spending on services. They weren't able to travel, go to restaurants, go to events, and really shifted spending on goods. And what that did is it really drove up inflation for goods prices earlier on in the pandemic. And then as things opened back up, consumers reshifted their spending to be closer to a balance between goods and services. They still haven't shifted fully back to consume the proportion of services that had been normal pre-pandemic, but that's been trending in that direction. And as that's happened, services inflation has continued to rise. And at this point, as we look at it today, goods price inflation has actually been falling and moderating. Services inflation has been rising, actually accelerating over 3 of the past 4 months. And certainly as we think about what drives the cost of services, it's largely wages, because people tend to be the largest input into service provision. And so as we think about what's going to be the primary factor that's really driving a rebalance in inflation, it's going to have to be coming from a rebalance in what we're looking at the labor. Because until we see supply and demand come back closer into balance, it's unlikely we'll see a situation where wage inflation really decelerates. So maybe I'll note, I mentioned at the start, the slide doesn't have a number. It would be slide 13 if it had a number. Apologies for that. Consumer spending has remained strong. However, both as we look at the data and talk to business contacts, there are signs of softening. And that's especially been the case, I would say, since the beginning of the year for lower and moderate income consumers who have been doing a lot more trading down behavior. So purchasing lower cost goods, non-name brand goods, going into the store to get snacks rather than into the restaurant, that sort of thing. Whereas when we look at upper middle, higher income consumers, demand remains very strong. And as we talk to our banking contacts, consumer savings have been drawn down, but are still historically in a really solid place. But as you've seen inflation as strong as it has been outpacing the growth of wages. And so consumers have actually been supporting this recent strength in spending by pulling down their savings. So at some point, we recognize that this may not be sustainable, because at some point, savings will get to a point where consumers are having to make a tough decision and say, we're going to have to pull back on spending in some regard. So we are paying close attention to that. And again, in the supply demand story, it does seem like there are indications that demand may continue to dampen as we look further on the horizon, both because of inflation and because we're just not seeing wages keep up with the same pace of price growth. This next picture on slide 14 shows exactly that despite the fact that wages have been growing historically at actually quite a solid clip, if you adjust that wage growth for inflation, they've actually been declining. And then slide 15 just shows, again, consumers overall, certainly there's a diversity of experience across the economy, but if you look at consumers overall, yes, more are saying that they're having difficulty paying for their usual expenses, but we still haven't seen a big uptick in, say, indicators from consumers saying it's become very, very difficult to cover the expenses that I need. So that's a positive sign that folks, even though we're looking on the horizon for some dampening in the fuel for consumer spending, it looks to this point like on average, consumers are still in a fairly solid financial. Okay, and in the interest of time, maybe I will pause my comments there. I appreciate the opportunity to weigh in. Please welcome questions.
I think you can keep going. There's
Great.
a summation you wanted to have. I think we're serving that. You feel free to keep going.
Wonderful, thank you. Well, then I'll move to the next slide, which I'm glad does have a slide number. So as we look at and think about inflation going forward, oftentimes what we do is not just look at what's happening right now, but look at the pipeline for price increases. And we can certainly see things like, as you look at the cost of core commodities, that can often be a leading indicator for eventually these things might make their way to consumers in the end. And fortunately, as you look at the orange and green lines here, kind of unprocessed and processed goods for intermediate demand. So goods that are still making their way through the supply chain, haven't yet made it to the final processor that's bringing a good to the end consumer. We're fortunately seeing prices for those goods actually decline. So that's a helpful indicator that we're going to continue to see downward pressure on prices going forward. But on the next slide, yes, inflation is slowing. Yes, prices for many goods are actually likely to decline going forward. But if you look at the overall level, it's still very high compared to where it was pre-pandemic. So this is no longer looking at percent change and just indexing these price levels to where they were early on pre-pandemic, and they still remain incredibly high. Going forward, the Federal Reserve leadership is watching data very closely to make a call about the pace of interest rate increases and, importantly, when those increases are likely to pause. And one thing that we are really focusing on internally and trying to articulate is these things act with a long lag and with a variable lag. And so we are going to need to pause interest rate increases well before we actually see true inflation moving back to a level of price stability, because oftentimes the lag historically can take up to a year or more before interest rates really have their full effect on pulling down inflation. And so we're spending a lot of time both slicing the data in lots of ways and being sure we are out in the community gathering information to get a sense of where are prices moving, when are things going to get back into balance. Because I think at its core, we recognize there is the conditions for a strong, vibrant economy with strong, solid job growth. The foundations of that situation absolutely has to be price stability. And it's not just the cost of living or the cost of doing business that is hurt when inflation is unacceptably high. It is even the ability to plan, the ability to invest, the ability for folks to engage in contracts or make decisions in the future are really held back when we're in a situation like today where inflation is unacceptably high. So we are laser focused on that and planning to do whatever it takes. Likely will continue to be moved to restrain demand over the coming year to bring things back into balance.
Very good. Thank you. Thank you very much for the presentation. As we get ready to take questions, Commissioner Bryson, I think you have one.
I do. Thank you. Thank you. Really great presentation. So what I just heard at the end, I think, is that you, even with the efforts that the Fed is making, we would expect, because of the lag, we would expect inflation to be persistent at least for the next year and on past that. Is that what you're saying? Because even the actions taken now will lag a year or more, I think you said.
That's right. I do not expect that inflation would persist at its current high level over the next year, but it will take some time. So we measure price stability as roughly 2% consumer inflation over the long term. And our expectation is the economy will not reach that point next year at this point. Certainly things could change, but we already actually see some price increases in the pipeline. So think about things like prices for housing haven't fully necessarily been baked into those indexes. some other pricing measures that haven't actually fully been represented. So we're likely to continue to see inflation potentially well above that 2% target that we have through next year.
Okay, so I think what I hear is, just to make sure I'm understanding. So I think what I hear you saying is we will see, we are likely to see moderation, but probably not down to the target of 2% for another year or more.
Right.
Following up on the commissioner's question, and I mean, inherent, an inherent question for anybody representing. What do you rate hike? If following on that answer you just gave, you are anticipating seeing inflation persist for a while, then we reasonably presume rate hikes will for a while. So, what are the thoughts on that as you?
Maybe I'll frame it this way. We generally see at this point, given the size of the economy, the makeup of the economy, that somewhere around 3.5% we consider to be a neutral interest rate. So a rate at which we are not actively stimulating the economy or pulling back activity. And we just reached that point in the economy. And so naturally, our approach had been to really be expeditious and aggressive in getting interest rates to that point. So increasing interest rates by 75 basis points for a historic number of times to really get interest rates at least to a neutral stand. I think there's a lot of confidence that things need to go beyond that to begin restricting activity. But the level where those interest rate increases stop really is still a bit up in the air. I don't think there is a terminal point in mind. I do expect, and there are already discussions internally about, okay, at what point do we need to slow the pace of increases, be increasing at a lower rate? So rather than 75 basis points, something a bit smaller at each meeting. But we will be looking at the economy for signals for when that stopping point might be able to be. So the expectation is potentially some further increases to a point that we hope is truly sufficient and restrictive enough to bring things back into balance. And then we will pause. And that pause is likely to take place, as Commissioner Bryson noted, well before we actually see inflation back to that 2% number. So there isn't a number in mind, but it is instead paying very close attention to what we see in commodity markets, energy markets, surveys of households, businesses, forecasters, and certainly looking at the underlying inflation data to get a sense of, okay, are we truly starting to see things turn in the right direction enough that we feel confident things are truly moving back to price stability over the coming 12 or 18 months.
Thank you. You know, as we get towards the end of this year, particularly in the news, we all have seen a lot of corporate job cuts. I mean, we see big names, Amazon, places like that cutting thousands, tens of thousands of jobs. I guess a multi-part question, why do you see that happening? What do you think that means for you? What do you or what does the Federal Reserve see economics may or may not?
Absolutely. We have all been paying very close attention to these big high-profile job cuts. In fact, many of them started toward the beginning of the year. And as I read the press releases and connect with the business leaders who are engaging in job cuts, many are describing it as things like growth was so strong during the pandemic. We were hiring as quickly as we could, and we weren't able to take a step back and pause and say, okay, are we really right-sized? Are we really running as efficiently as we could? So many are describing the job cuts less about, okay, a protracted decline in demand, and more, okay, how can we be sure we're running lean and we're running this business efficiently moving forward? For the most part, these are getting a lot of press because they're big, high profile. Earlier in the year, it was really high profile retailers. Now we're seeing it tech companies. they're getting a lot of attention in the media. We are still overwhelmingly hearing, both anecdotally and from surveys, that businesses, if you look across the entire swath of the economy, nationally and in Tennessee, on average, business leaders say their greatest challenge today is securing the labor they need. And for the most part, out in the economy, having these conversations, many say, oh, give me the phone number of these Twitter employees or Facebook employees. I would happily hire tech workers today. And so to a large extent, I'm taking a little bit of a wait and see approach, because it's possible some amount of this is a natural reshuffling. It's getting a lot of attention in the media, but hasn't yet gotten to a point that seems to really be showing up as a big swing in the data. We are currently at such a big mismatch between supply and demand for workers, both in the state and nationally, that a softening in demand is still leaving us with quite a tight labor market.
Mr. Treasurer.
Yeah, I appreciate those remarks about the workforce, Ms. Brafey. Let's talk about the participation rate, in the workforce. Participation rate's been as high as 68% in 1990s and everything. We're down to about 62% now. It's come back up a little bit because it was even lower than that during the pandemic and everything. And, the inflation that you described based on demand for goods and services, particularly the services side, is dependent on having enough people seeking jobs in order to provide those services and or manufacture those goods and everything. And so I just wanted your comment on my supposition that inflation is not going to be significantly restrained until the workforce is brought more into the participation rate to participate and actually seek these jobs and get training that's necessary. I happen to think personally we have a very serious workforce training and education issue in this country that is going to result in longer term trends that are going to be extremely hard to manage from an economic standpoint going forward. But I'd love to have your thoughts and comments on that. Mm-hmm.
This mismatch, the shortage of workers relative to the amount of work that done. This absolutely has to be resolved longer term the economy. Interestingly, some of what we've seen in participation, certainly you can cut the demographics any which way. If you look at what the Bureau of Labor Statistics considers a prime age worker, 25 to 54-year-olds, that participation is actually up compared to where it was pre-pandemic. Where we've seen the drag on participation is actually on the two ends of the age spectrum. Folks 60 and older tends to be the greatest weight of what we're seeing, both because their participation has declined the most of any group, and also because that's a bigger portion of our population today than it ever has been. And so the economy had really benefited from a historically unusual high participation of folks who were retirement eligible following the financial crisis all the way up until the pandemic. And that participation has pulled back, actually not in a way that is historically unusual, but that we had not been accustomed to since before 2007, 2008. And certainly surveys of those workers, there are some that cycle back into the workforce, but that doesn't seem to be happening in a historically unusual way. And then on the other end, actually something that I consider perhaps even more concerning is younger workers. So it actually isn't the kind of high schoolers, folks in the early college years. They're back to work, and actually back to work at a higher rate, taking advantage of these high-paying service jobs out there nowadays. It's the folks 20 to 24 right now who are participating at a lower rate. And traditionally, that's not unusual to see during an economic slowdown as people decide to opt into higher education instead of the workforce. But in fact, that's happening, as you pointed out, at the exact same time that we are actually seeing participation in higher ed decline. And so when we talk to public health professionals, oftentimes we are reminded that the kind of mental health crisis and some of the issues both around addiction and other mental health challenges, a lot of that is concentrated on this younger population. So as I think about the path forward for the economy, I really am focused on how can we get those folks engaged in the workforce, skilled up, and like you say, ready to participate, not just in the jobs of today, but the jobs of the future. And I think there's a real gap right now to fill to get us.
Thank you for your views on that. I'll note anecdotally that Dr. John Smith from East Tennessee State University and his colleagues that are here today have in their materials a labor force participation chart. So I look forward to also hearing from them about this. So.
Mr. Secretary.
Thank you very much. Great presentation as always. Always interested in the savings rate. But tell me how that's calculated. You have a slide 13 that shows savings rate is almost, well, pretty close to a 10-year low, if not a little longer. How is savings rate calculated? Is that net of retirement savings, include retirement savings?
It should include personal retirement savings. It would not include entitlements. I don't believe so.
So 401ks?
It should include 401ks. So
Okay.
actually the savings rate is less about actual deposits in a liquid account, and it is more a kind of zoomed out extrapolation of disposable income minus consumer spending. So it could include other, whether it's 401k or other sorts of investment types of activities.
But you do reach a point, you mentioned this earlier, that to support the lifestyle that people maybe grew accustomed to living the last few years, they start to save less to support that standard of living. At what point, this chart, do you feel like we've reached a point, because people are going to still contribute to pays if they're already contributing, might decrease. But at some point, there's a real danger zone in there where you don't just decrease how much you're saving then, you start to dip into what you have saved to support that lifestyle. And you stop spending that, when you stop spending that money on taxable items, and obviously we see tax revenues fall. So where's the danger zone in there when you see savings rate?
Great question.
I've been working on it, so thank you.
The thing, I like this picture because I think it tells a clean story. What I don't like about it is you can break down so many different cuts of the population and this data would look very different. And again, I will point out, as you look at especially lower and moderate income workers, their savings at this point in many cases are negative. So they are, as you said, actively dipping into savings. We're seeing folks rely more on short-term and payday lending. We're seeing folks shift their shopping from being spread out to when they need, say, household items and groceries to shopping on or immediately after payday for those individuals. So we are already seeing actually, I think, an inflection point for a certain segment of the population.
You've got a slide 15, share of respondents in household surveys. It's not at all different. Usual expenses. The person you probably described is probably obviously down at that red bar level, and it's always been difficult for them. Cases. So not only are they saving a lower rate, they might have been saving to start with. That savings rate probably is even worse than we realize, because at the green line, we see that decrease. That's the person who's probably saving a lot less. So the scenario for savings rate is probably worse than we even thinking.
Yeah, that's a wonderful point. And I think it draws me back to some of the information. We even saw this in the retail sales data this morning, that there's a lot happening right now in the mix of what's happening with consumer spending. On the one hand, some of the data is being driven by the fact that, say, car dealers and car manufacturers are catching up a bit more. So there's just a supply of large items that consumers had been needing and waiting to purchase. Now that it's available, they're purchasing. Is that a sign of a big boom in demand last month, or is it just a sign that finally they're able to purchase what they need? On the other end, we are seeing in many cases consumers actually keep stable or decline what they're purchasing, but because prices are increasing, the headline number looks like growth in demand. And this is exactly what you referred to from a savings perspective. Folks are already having to make trade-offs and do things like purchase lower cost items, purchase less nutritious items. Some of that is already playing out for some of our consumers. And it feels like so long ago, but during the pandemic, especially when there was a really strong fiscal support in terms of direct impact payments to consumers and the supplemental unemployment benefits, that lower income consumer also was seeing the strongest growth in demand for work and strongest growth in wages. So that segment of the population that historically, like you say, that red line has always existed. It's not new. There's been a segment of our population that has always struggled to make ends meet. And actually what was unusual was during the pandemic, many of them were financially better off than they ever had been in their lives. And to some extent, some of this transition is a reversion back to how things had been pre-pandemic. And I think the hope is that we will get inflation under control. We will help get the job market more stabilized so those folks are prepared to contribute to jobs in a higher productivity way so that their wages can really keep up with their consumption needs.
Well, thank you, because there's no doubt that the people at that red line, they're the most negatively impacted by fast rising inflation.
That's absolutely right.
Commissioner Bryson.
Thank you, Mr. Comptroller. I'll make this really fast. I'm just thinking about, you started off this talking about that Tennessee for once had some real significant demand differences than the whole U.S., yet we're part of the entire U.S. economy. So as we're thinking about setting budget targets, the question comes to mind, is there a significance there that we need to be thinking about where Tennessee is going to be different, significantly different than the numbers we see? And some of the people that come after you may address this, but will there be a significant difference in the way we think about it and the way we would think about it nationally?
It's a wonderful question, and I would say I suspect the gentlemen who come after me will have more detail on this. I think maybe the one thing that I would pay the closest attention to is what we've seen in Tennessee has really been impacted by the in-migration over the past couple of years. And so an opinion about where that's going, what that's going to end up looking like. Are we seeing a stabilization? I've seen forecasts all over the map about where this might land. But I think in some ways just a recognition that what has gotten us to this point in these last couple of very strong years have very, very largely been impacted by those trends. And it's been truly across the state. And so as I look going forward, thinking about, okay, what does rebalancing look like? I think broadly the same factors, as I mentioned at the outset, the same factors driving the national economy, they're likely to be the major players here. But I would say the primary distinguishing factor that I'm paying really close attention to in Tennessee is how is this next year going to show a rebalancing, a continuation of these trends in terms of population?
A quick question just to follow up on that. Knowing the extraordinary in-migration we've had, I mean, the third most moved to state during the pandemic, knowing those people have poured into our state, where are those? I mean, where are the workers? I mean, if we've had that many more people come in, surely they're not all retired. I know they're not. Where are they working? Where is the workforce? You know, I walked into a restaurant on West End Avenue 2 weeks ago yesterday, and it was empty. And I said, hey, can I get a table? They said, well, 30 minutes. I mean, the place is empty. They just didn't have the workforce. Where are these people?
Wonderful question. For the most part, folks moving into the state have been folks coming to work. So we have done a remarkable job in Tennessee of keeping the unemployment rate low and getting the folks, again, the people moving into the state tend to be relatively younger than the population on average. They tend to be relatively higher skilled. And both of those things make people more predisposed to participate in the workforce. I think part of our challenge is it's bringing a supply of labor, but it's also bringing a demand for labor. So I suspect the line for 30 minutes at the restaurant also included people who were new to our state. And so part of what's been happening as we've been meeting the demand for labor, but at the exact same time, we've been growing the demand for labor. Many of these folks are working, again, relatively higher skill jobs. There's of course been a higher incident of folks being able to work remotely. And I know there are a lot of pop culture stories about now you can have a wonderful, affordable quality of life in some of our less urban areas across the state of Tennessee and earn wages that you had been earning in kind of high cost of living West Coast or Northeastern locations. So part of it is this higher rate of remote work is also meaning people in Tennessee are not just meeting the needs for workers of Tennessee businesses, but are working in some cases across the country. I would say that's not the driving trend. If I'm pointing at what's pushing to the shortage of workforce right now or this mismatch, I think it's more broadly that demand just remains incredibly strong. And especially, as you noted, demand for services, for tourism services, for logistics services, for all of these spaces remains incredibly strong. And at the same time, in a really strong labor market, a lot of what we've seen is workers who would traditionally fill those roles, they're actually changing industries and they're taking jobs that generally are I don't want to judge a quality of a job, but are more attractive in many cases. So some of the jobs that are hardest to fill are jobs that require people to do hard manual labor, work night shifts, work unpredictable shifts. And one thing that's been pretty remarkable for us is these job shortages are not equally distributed across the economy or even across roles. And we have been really trying to dig on my team at the Federal Reserve into what are the things that employers have been able to do to attract workers? Because it is not uncommon for us to connect with employers in the same industry, in the same region, where some have been able to shift the way they approach their workforce. And it's about pay, but it also is just about quality of life. Is there unexpected required overtime? Is there temperature control in the facility? Do folks feel like they have access to the training they need, the job path that gets them excited about a career growth? Oftentimes firms that have been able to adapt in order to provide, it's more of a kind of whole job shifts to make jobs more attractive to workers, are generally telling us they're having a much easier time securing workers than firms that, sometimes due to no fault of their own. There are some work just needs to happen overnight. Some work needs to happen in the cold today or in a dangerous environment. And I think what we've seen is it's some of those that have been most persistently hard to fill, and I think come with the biggest question marks about how can we be sure that the jobs that need to be done are appropriately filled.
Thank you. And I had some follow-up questions, but you answered them in your answer. So that was great. Members, I have one more summation question. Any other questions right now? So my summation question for you, as a representative of the Federal Reserve, as a Tennessean, the presenters that come after you are coming with advice in regard to revenue projections for the current fiscal year that we're in and for the out year. Your presentation doesn't have that, but still I'm going to ask you, what would you advise us to do in terms of revising revenue in the current fiscal year, which ends June 30th, but even more so for the year that begins July 1st, thinking about the potential economic trends, the potential economic turndown, what, maybe not a number range, but what philosophy would you recommend that we use as we do that, knowing we're in a sales tax based economy?
Thank you for that question. And I will note, I do have the privilege of, as a Federal Reserve employee, being prohibited from it on fiscal. So I get an easy out for that one, but I will, as a Tennessean and
As a Tennessean.
as an individual, I'm happy to weigh in at least on my thoughts about the coming year relative to the past year. I do not mean to skirt your question.
Sure.
In some ways, I think the state is facing similar conditions as I would say a household right now. That we are likely moving in a situation where demand is cooling, and demand is moderating. Maybe I would say beyond likely. The Federal Reserve is ensuring that we are moving in a situation where demand is cooling. And I look both on the revenue side and importantly on the cost side. That there is real underlying growth in revenue, and there is kind of top line growth in revenue that can be driven by higher prices. And my sense is that over the coming year, we're probably likely to continue to see inflation push up those top line numbers, both in terms of revenue and in terms of our cost. Just because the cost for labor, the cost for equipment, goods and services, those things are going to continue to be impacted by inflation, as is our revenue. Your revenue.
Ours, you're a Tennessean.
As a Tennessean. On the demand side, I would expect consumer spending to cool. Thus far, both talking to retailers, broad surveys, both across the state of Tennessee and nationally, retailers still are quite optimistic and are saying, look, we're expecting a moderation from the really strong pace of growth over the past couple of years, but we still expect growth in sales over the coming year, potentially a slighter correction in the early half of the coming year. But retailers are still generally, again, I'm broadly generalizing, saying they're fairly optimistic, but are prepared and are spending a lot of time thinking about what's the downside risk. When we ask contacts to weight where they see the risks to their forecast, yes, the forecast is pretty good, moderation in growth from the past year, but still growth. But they're telling us if they are wrong, they're wrong because it's going to be worse than they expected. And my sense is that looking at the state and looking at consumer activity, and given our sales tax focus in the state, I would generally think of things in a similar way.
Very good. Thank you very much. As usual, members, one more time, any further questions? Thank you for being here again with us. We always appreciate it. Thank you very much. Members, we will, as I mentioned, keep on keeping on. We will keep on keeping on. And our next presenter is Dr. Dawn Bruce. Dr. Bruce, welcome to what is your first presentation to this committee on behalf of the Boyd Center for Business and Economic Research. You, like me, have the heavy task of coming behind a storied predecessor, Dr. Bill Fox, who's not with us today. But we're glad to have you, and you are recognized.
Again, thank you. To carry on this impressive legacy. I'm sure you morning, even though he may be physically elsewhere. I'll say I appreciate your necktie game. Not say that. I did buy it just before. So started out with what I always think of and thought of really literally as the EKG of the American economy, the rate of inflation adjusted heartbeat of the economy. And until the pandemic experience, it didn't look much like an EKG. Flatlined for a hot second there in 2020, cleared the room, generated the economy very quickly, and it settled into more. The reality of the recent history, though, is we're bumping along close to zero. Very slight to possibly even negative growth at the national level. And in fact, national forecasters are building in these days modest recession starting. That being said, that's a national story. It does form the basis for our advice, and I will be very clear in telling you I am not an employee. Happy to advise you But the basis for our revenue forecast, we're relying on basically on a national forecast that shows low to zero national growth. We do expect, echoing the earlier thoughts, lingering inflation in the economy and in that pain. But I will say my point of departure is that things are generally better in the state of. So we should be very proud of the fact that last year in 2020, fastest growing across the board, well above the U.S. growth rate of 5.7. I should point out that in my slides, orange, of course. But even going back to the Great Recession in the mid 2000s, we've outpaced the U.S. Incredibly strong recessionary period, behind a few of the other AAA rated states, well above U.S. average, both nationally over the reason to expect company time. Let's get to the big picture. This is literally focus revenue growth this year. Inflation is the dominating story, and it will continue. As we've heard, the pandemic, as I refer to it, the pandemic in 2020 caused every American, regardless of their age, to go home and have a midlife crisis. We've all reevaluated our attachment to employment. We've evaluated the place of work in our lives. This is real time. Now we can all stare at that inflation picture for just a little bit longer.
Test 1, 2.
One, two, three. Back on up. I'm trouble hearing. Excellent, excellent. Well, I will not give them the benefit of starting over, so if that's okay with you. The inflation picture obviously is dominating the news on that, but I will show this figure. You will see the are starting has come down. It's important to recognize we haven't been in an environment like this, inflationary environment. There were few channels on the TV funds rate 70s, get up and walk. We don't remember what inflation feels like. We don't remember. I can assure you the federal does not want to repeat. Cautiously optimistic experience will see signs of relief. Big part of my story is that other than inflation and the financial market volatility dominate the headlines, the current economic situation does not necessarily resemble post-prior recession. Highlighted already. We continue to see very strong employment without these low negative growth rates in real national and state level, and these exceeded U.S. job growth most of the recent job growth at 4.5%, well above U.S. job growth. Secretary Hargett knows we've seen a more than full recovery in employment, well above pre-pandemic employment. Fine. Alongside that, something we can all be proud of is Tennessee has seen absolutely phenomenal term innovation, new business filings. Office speaks to Tennessee's resilience and entrepreneurial climate, as well as prospects. One major reason to see Tennessee outperforming. Since the Great Recession, We've added 16%. See, our employment growth has been eighth nationally, well above the national average. Well ahead of most other states. All sectors, importantly, have fully recovered from the pandemic. Big news, we've not been able to say that in these kinds of presentations for quite some time. And the most important punchline there, that leisure and hospitality has finally added jobs relative to their pre-pandemic. Hospitality is not only an important part of the growth and employment. You see Tennessee adding 4.1% over the last couple of years since the well above the U.S. adding just less than 1%. While the story is great across sectors of the economy, it's not entirely shared geographically across the state. And so what we're showing here is that the growth rates in employment very strong, driven, as we all well know, by Middle Tennessee. Today is 40% up in relative to the only major metro area in the state that is not back to where they were before. Carry that load here for our friends. Good. Let's see. Our unemployment rate continues to fall. Slight tick up in the most recent data, but well below historical averages. 3.4% in Tennessee relative to 3.7 nationally. The bigger story with the job market, though, is the imbalance that we've heard about already this morning. Job openings off the chart in Tennessee. So of all the jobs that are or could be filled, 7% of them are open right now. That's a big percentage of our labor force right now, of our employment situation. The job openings continue to be quite strong at the state level relative to the recent trends, slightly downward at the national level. Importantly, we have far fewer unemployed people per job opening in Tennessee right now. And the summary of this is for every unemployed person in Tennessee, there are 2.5 job openings right now. We have got to address that imbalance in some way. And we've done it historically by importing workers, as we've already talked about. So 2.5 positions per unemployed person places intense upward pressure on earnings, but it so far has not placed upward pressure in a substantial way to the Treasurer's early comment on labor force participation. And I will go ahead and scoop my ETS colleagues and show you that labor force participation graph. Tennessee's labor force participation down, certainly relative to that pre-pandemic peak, and certainly relative to the earlier peak in around 67% in the early 1990s. The important thing to take away from this is our decline in labor force participation is not a pandemic phenomenon. It's been declining in labor force participation for many years. And that is a rational decision by former workers. Some are retiring early, some are deciding just not to work at all because work is not as important in their life. They've got other sources of income in the household. Standards of living have gone up. There's all kinds of reasons for that. Importantly, we have recovered some of the pandemic loss in participation, but we're still well below that peak. And it is a story that we need to continue to look at and think about. But it has placed incredible upward pressure on earnings, and that translates into income growth more broadly. Personal income is up 5% in Tennessee, 5.05 over the past year or so, and that fast outpaces the U.S. growth rate of 3.1. And I would highlight that this growth is well beyond the end of federal pandemic-related stimulus programs. This is reflective of natural underlying economic growth. But of course, we know, as you've highlighted, this is inflationary pressure in the economy. A few quick notes on housing and vehicles before we get to the revenue forecast. And just really quickly, the auto sector is very important to Tennessee. Nationally, sales of new light vehicles down substantially throughout the pandemic. We are in a period of reevaluation in that sector as we transition away from traditional auto production toward more mechanized, automated production and electronic vehicles and autonomous vehicles as well over the longer term trend. we will be paying attention to this one, but obviously down below where we have been in terms of new vehicles. The bigger story is housing, as we know. In Tennessee, house prices grew by 25% on an annual basis last year, and that is just simply unsustainable. Some would call that a bubble. Others would call it really nice windfall gains that they're turning around and spending in the economy on, in some ways, on sales taxable items. But we are seeing a few signs of a cooling off in housing, and this is deliberate. It's absolutely directly related to federal policy. They don't control mortgage rates, but the financial markets are intertwined, and what we see are things that require borrowed funds starting to slow a little bit. So what we've seen is there are a few more listings on the market these days in Tennessee, and the time to sale is a little bit longer. And those sale prices aren't necessarily coming in above list the way they were a year or two ago. That's going to be important because as we think about solving our problems by importing workers, they've got to have a place to live. Housing supply is critically important to that. We've got to add supply. There's no question about it. I'll quickly highlight a couple of revenue sources. We are seeing the slowdown showing up in realty transfer and mortgage tax collections. That is absolutely a sign of a cooling off in the housing market. But quickly shifting, and then the revenue side, permitting is down sharply in response to the rapid growth in mortgage rates, the slowdown in home buyer activity the past couple of months. That being said, the pace of new permits is still quite strong. It's just down sharply from the unsustainable highs that we saw in 2020. Again, we will need to continue to add housing supply to this economy in order to deal with the pressures that we face with the labor in general. So to the revenue forecast. Our sense of this is exactly in concert with what Rafi said earlier. We can expect to see continued inflation at a moderated rate through the next 12 to 24 months. We will not be anywhere near that target rate in our sense in the Boyd Center until sometime in 2020. That is potentially rusty for the economy. It's not necessarily what I would say is bad for the economy, but place pressures situation. It is for your benefit, good for tax collections. Inflation does improve tax collections in Tennessee, and I'll show you a picture here in just a minute. But it remains a very difficult enterprise to forecast tax revenues, especially on the heels of what we call 2 years of unprecedented growth, driven by massive growth in demand and spending ability, personal income, arrival of new Tennesseans, all sorts of things adding to this tremendous increase in collections. Business activity is at an all-time high. Sales tax collections up dramatically due to our ability to collect taxes on online sales and to get this to the locations across the state where the buyers are actually living. All kinds of trends have given us 2 years of back-to-back double-digit growth. We are expecting a moderation in that growth to about 6.3% through this fiscal year. Then again, moderating slightly to 4% fiscal year 24. That will be driven by continued strong collections, and they are good year to date in sales and franchise and excise taxes, as you all know, the two pillars of our state tax collections. Some interesting things to point out. We will see most series growing fairly well, although the decline in real estate activity, which we are already seeing, will continue to see, will dampen privilege tax collections this year. Like some rebate from that, and then back to more normal, sustainable growth rates. General fund growth about 7.2% is the current expectation for fiscal 23, moderating to 3.8% for fiscal 20. I view these importantly as conservative estimates. I think there is a reason to expect that Tennessee's situation will be very good relative to the national picture. Always want to be careful, not plan for the best days. Just a couple of quick pictures, and then we'll questions and discussion there. But we've not had growth that's like we've seen in 21 and 22 without a tax rate increase ever in the history. And there's no reason to expect this unsustainable digit growth to continue. Wise to continue. Conservative in projecting revenues going on. More importantly for the discussion today, inflation is going to drive collections. In fact, we are really not projecting much in the way of real growth. It's the conservative piece forward. Growth that we're projecting is almost entirely inflationary growth, off ramp from these current high unsustainable. That being said, I appreciate the opportunity to come before you and be happy to discuss any of these or other issues.
Thank you very much, Dr. Bruce. One quick question, thinking about what you just said. Inflation certainly does drive revenue growth in Tennessee in the short term. But what happens when you reach a point where inflation is so unbearable for the consumer that they stop buying as many goods? And so I guess what's the long-term effect of inflation on the Tennessee economy? And with that, do you forecast an economic slowdown of moderate level, of harsh level? And if so, when would you anticipate that to begin?
Questions, and I appreciate the opportunity to say a little bit more about that. We do worry about the extent to which price increases cause reductions, especially consumer spending on sales taxable items. We're not seeing that in the data. Very interesting. Even as we've shifted back towards services, even as we've maybe goods grow, and this morning's real sales data are showing continued robust growth, which would be a bottom end minimum lower bound for Tennessee. At this point, I'm not thinking that is going to be the story with macro growth going. We're thinking about with GDP nationally is a slowdown driven by things that are dependent on interest rates, things that do respond directly to federal funds rate increases, things like investment from businesses, and investment from homeowners and residential. Those things slow down. On net, we may have a negative real GDP situation over these. I don't think we're going to see that in Tennessee. In fact, our forecasts we're in the process right now of finalizing our next economic report to the governor. I don't believe we're preliminary, although very clearly, I don't believe we're going to see a strong recession. Certainly not.
And so extrapolate a more, let me ask just kind of a simple sounding question. Where are people getting this money to spend? You know, and I feel like I can answer that question for the Nashville area, but where are people where I live in the Tri-Cities and you know, in between getting that money to spend?
Well, I think what we've seen with this massive imbalance in the labor market is a workers' market right now. I haven't shown you our data on separations and rates, which are really all-time highs right now in Tennessee. Workers have all the power, so they are either moving around to higher paying jobs, or they're successfully bargaining for higher pay from their employer. That is very important because that places additional pressure on inflation. But many workers have been successful in getting pay raises. The problem I think they have faced is the pay raises have not kept up with inflation. So you might get $1,000 pay raise, prices go up enough, $1,100 more for all the things that you need, you're ending up in a worse fiscal situation personally. But to your question, the money is coming from better labor market contract and the shifting of the workers toward higher paying jobs.
Thank you. Members, what about other questions, comments? Mr. Secretary?
This is probably an answer I should know, but is that jobs filled or jobs available?
Oh, employment is jobs filled. That's people
Okay.
actively working.
So,
Yes.
so when I
get
look
back
at,
to-
you made the comment, leisure and hospitality has finally rebounded to the very level. If we filled all the leisure and hospitality jobs that were available, what would that number be?
Oh,
Because I believe you mentioned later on, 7% of the out there not being filled. I'm trying to figure out more granularly what that breakdown, that 7% is, where those.
I think it's safe to say, thank you for the question. I appreciate that. I will say it's safe to say that most of the openings are below median in the wage distribution. I'm not comfortable saying which percentage of them are in leisure and hospitality at this point. I will say that we expect that sector to lead job growth along with manufacturing in a year or two. That's been the issue as the labor market has resorted and reshuffled. Everybody's looking around and finding better opportunities. Might not be better paying opportunities. They might just be better working conditions. Schedules, being able to work from home, being able to work regular, predictable work week. These are things that, and we will be paying close attention to leisure and hospitality here in the next several months. I will say to the earlier comments on importing workers, a certain large amusement park in East Tennessee had this figured out a couple of decades ago and was famous for bringing workers in from other countries, housing them. Might be time to revisit that model. We'll have to figure out if we want to have healthy and vibrant leisure and hospitality sectors, and we want to continue that affordable, we've got to figure that issue out. Thank you, Dr.
Mr. Treasurer.
Can you hear me okay? Let's talk about a couple of factors that could affect Tennessee's economy. I want to get your thoughts about it and everything, Dr. Bruce. The ability of Tennessee to receive sales tax revenue is, of course, dependent on, in many cases, the availability of credit. For instance, light cars and trucks is a good example. It's a big item in Tennessee sales tax collections. And, you know, it's kind of like one of those things. Of course, there are some people who buy them for cash, obviously, and everything, because they've got a source of it and all. But a lot of folks, they're borrowing that money. And so their ability to buy that vehicle is dependent on their ability to either A, get, or B, to cash flow a loan, you know, and everything. Have you seen anything that would indicate there might be any issues with that going forward from your standpoint? Because housing is a different thing. Housing, as you put out in your presentation, the housing market is showing signs of responding to the issues involving the mortgage rate and all that. But we also have all these other areas that we're dependent on other than housing credit. So any thoughts about that?
Yes, thank you, Treasurer. Appreciate that. The interest rate is
Mhm.
consumer interest rates, credit cards, on car loans, all of it. I will highlight it is absolutely intended on behalf of the American people to slow the economy down right now without recession. Signs of success. We've seen a slowdown. Those are responsive to higher interest rates. And if people are putting off those purchases because of credit, not necessarily a bad thing for the economy. Certainly better than getting in a credit situation that's unsustainable. So we want to make sure we watch that and make sure that it's not a catastrophic reduction. I think folks who need cars are still generally able to live. Might be downsizing or in a lower price bracket to make sure that the day. But in the end, we are actively trying to reduce those kind of goes to business investment as well. The extent to which we can use interest rate tools, have a much quicker policy response. Use interest rate on a gradual, low, moderated basis, longer term from that rather than the dives that we got in the 1970s.
Let me ask about your thoughts on one other thing that could potentially affect the equation, and that is the Fed's intent to reduce its balance sheet, and that, of course, will have the effect of shrinking the money supply over time and everything. And of course, we've also got, stimulus programs that have expired, et cetera, that were around during the pandemic and all that, put more money into circulation. So do you have any thoughts about, what might occur in the going forward future here for the next year or so in terms of those being a factor and how Tennessee's sales tax might respond to other sources of revenue for the state?
Yeah, that's really interesting. Really great thing about the environment. What is it is to have gridlock, if you will, nationally, at least a lack of agreement broadly nationally, is the Federal Reserve is able to operate. They're able to do policy the way they best know how. Fiscal policy side of the house can kind of remain quiet for a little while. Unfortunately, it has. We've done a few things nationally. We haven't done maybe as much in Tennessee and haven't needed to. Our tradition of operating efficiently with low tax rates and very broad tax bases, steady growth. Nationally, I think we've pretty well quieted down any talk of massive spending growth. We learned our lesson from the pandemic. Certainly shocked the economy back to life and kept things being worse than they might otherwise have been. Don't see first for fiscal policy side approach. Tax cut from those sides of things, especially now that Congress. I really do believe this is the time. Allow monetary policy to do it well. Tennessee has a good tradition.
Okay, thank you for your thoughts.
Commissioner?
Thank you, Mr. Comptroller. Just a quick question. When I was listening to Ms. Grafey, it seemed like there were kind of three components to growth. One is kind of is inflation, obviously. What I wrote down is net economic growth, but also she really focused on in-migration and how that has impacted Tennessee's economy, particularly. When you put your projections together, you talked about economic growth or the lack of it, the inflation. You didn't really say much about is the net immigration. Is that just incorporated into the economic growth model, or is it something we need to look at separately?
Well, we don't see a reason to expect a sharp reversal of immigration. Tennessee continues destination state. Should be proud of that as well. There are jobs here for folks who jobs, and that's a great thing. That's how we've been able to keep up these past few years. Our participation rate has gone down. And we've still somehow managed to add over 100 jobs since because we've been able to add workers broadly. Concept. The extent to which we can continue that, we build that into our projections for sure. We don't have any reason. Will it slow? Absolutely. We don't anticipate the midlife crises type events wanting to happen every year. It is a very different labor, very different. We're experiencing a cultural shift, actually. I think that's to Tennessee's advantage. Have a life. Also have a great job.
To my understanding, I think what you're saying is that you've built this on the model of how the economic growth has been over the past few years, and the net in-migration has been baked into that, and so you anticipate, so it does take that into effect, correct?
Absolutely.
Thank you.
Clarify if I may, there's no way we get the out in migration because you probably know the natural rate of population growth.
Members, any further questions or comments for Dr. Bruce? If not, we thank you for being here. Great job on this first time, and we appreciate it very much. We're going to move in our agenda next to hear from ETSU, Dr. John Smith and your team. Come on down, and I will let you, Dr. Smith, introduce the other members of your party. And you are recognized.
Gentlemen.
Yes.
Thank you for the honor of letting me speak to you today. I'm Jenny Smith and Makara. We work on the forecast together, so we also present. Start us off by talking about the national economy. Brief look, and then I'm going to talk about the state. John's going to give you our revenue forecast.
Thank you. Pleasure to be here. What we call economics today used to be called political. That was because it focused on that primarily affected policy making. Although much has happened in the evolution of this mathematical models, but we often find ourselves right back into the political aspects. That's what we're all
Okay. And it means that what happens in national and state economy and both decisions made by political leaders in Washington. With what appears to be an even split in the Congress, there's a possibility that legislation designed to fix the economy will be difficult to pass. With that admittedly cynical preface, let's begin to look at some economic indicators approach the end. Place works. Well, this first chart shows that new claims, well, let me preface this by saying because a large part of the Tennessee tax revenue spending, which is closely linked with income, which is closely linked to employment, let's look at trends in employment and income. This first chart shows new claims for jobless benefits. This chart shows that claims have continued at around the same level as we saw last year. This is also one labor market indicator that has proven to be a reliable forward indicator of overall business conditions. But a more mixed picture of the labor market can be seen in the next set of charts. This first one comes from the Labor Department's Job Openings and Labor Turnover Survey. This chart of hires, openings, and quits shows that openings have been on the decline since peaking at an all-time high back in March. Meanwhile, hires and quits, each of which are positively associated with a strong job market, have been on a downward trend. These suggest that when taken together, some slowing in the jobs market. The labor force participation rate has been referred to by previous presenters. This shows a percentage of the adult population that is in the labor force, either employed or seeking employment. It continues its slow recovery to return to its pre-COVID recession level, but it is increasingly questionable whether the participation rate will ever return to levels, let alone. This also limits complete recovery in the labor force and the associated benefits of the economy in terms of income, spending, and of course, spending-related tax revenues. Adding to the difficulty of the expansion has been the Fed's intense anti-inflationary policy for many years in the past. After keeping credit plentiful and interest rates low for a very long time, the Fed has begun an aggressive anti-inflation strategy. And this is starting to affect other interest rates in the economy. We also see this reflected in measures of the money supply, both in nominal terms, as well as in terms of what we call the real growth of money or inflation adjusted in money supply. The effects of this tightened policy have already hit the real estate sector. Sales of new and existing homes have declined significantly. And because such sales have a multiplier effect in spurring other categories of spending, this could augur a more widespread downward trend in overall consumption spending. Similarly, we have seen a flattening of the growth rates trends for after-tax income and consumption spending. In particular, spending on goods, both durables and non-durables, have been on a slightly downward trend. However, as has been mentioned before, spending on services continues its recovery from the hard hit that it took during the recession. For consumers, a major positive in the economy is the recent slowing of inflation after many months of continued acceleration. Nevertheless, the rate of price increases is still rather high by pre-recession standards. Meanwhile, wages have grown continuously since the beginning of 2021, at least in nominal terms. But when adjusted for inflation, wage growth is only recently turned positive. Finally, when we turn to take into account consumers' rather negative outlook about the current and future economic conditions, the outlook for consumer spending is somewhat questionable. So taken together, the medium-term outlook for the economy seems somewhat negative. Indeed, it may not be unreasonable to use the R word for that outlook, maybe as early as the second quarter, but maybe not until the fourth quarter.
Okay. Now a brief look at the Tennessee economy. Tennessee civilian labor force was 3.4 million in September. This has grown by 34,000 workers since December 2019. So we've more than recovered from the lockdowns and now exceed the pre-pandemic level. The Tennessee labor force participation rate has remained depressed following the lockdowns, sitting at 60.5% in September, down from the peak of 62.1% in May 2019. We were as low as 59.4% only a few years ago in 2014. Yet before that, we have to go all the way back to 1976 to find such a low rate. Population of Tennessee grew by 145,000 to almost 7 million people between 2019 and 2021. So the data suggests that a disproportionate number of citizens are retirees. This seems consistent with our experience in Northeast Tennessee, where in June, the Bristol Chamber of Commerce estimated local labor force participation rate of 53%. The state unemployment rate is fully recovered and is back to the pre-lockdown level of 3.4%. This is close to the all-time low of 3.3% in much of 2019, and likely represents the natural rate of unemployment, meaning there's nowhere for it to go but up at this point. This is also below the 3.7% seen nationally in October. We continue to see heterogeneity across MSAs ranging from 2.5% in Nashville to 4.6% in Memphis. Retail sales are rising with inflation. As the major source of state revenue, inflation will continue to drive up nominal tax collections for the state, while also increasing expenditures as the cost of all government purchases increases. To the extent that households are drawing down their savings to fund their spending, there's a risk that a recession in 2023 would negatively impact this trend. State output has resumed its long-run trend despite the interruption caused by the lockdowns. Continued growth in the labor force, coupled with further investments in capital and technology, will ensure that state output continues growing in real terms, as will income and spending. We have several slides covering the state housing market, which is currently in crisis with a monetary policy adversely impacting both the supply of and demand for housing. High monthly mortgage payments in the coming years will mean much less money for newly formed households to spend on all other goods and services, including everything from appliances to furniture and all consumer goods in general. The only real solution to the housing shortage is to build more housing units, but high prices and rising interest rates are driving down both the construction confidence index and the new housing starts. And there's the housing permits here. The shortage will also negatively impact institutions like ETSU, since we have relied on a lower cost of living to attract talent to the university, but starter houses have simply disappeared in our area, destroying the cost of living advantage we previously held over some cities. The state can't sustain growth in the labor force if workers have no place to live. I also expect periods of high inflation in the future as continued deficit spending in Congress, coupled with evaporating liquidity in the Treasury market, will compel the Federal Reserve to purchase large amounts of U.S. debt in the coming years and decades. The Secretary of the Treasury, Janet Yellen, has been expressing concern over this fact as of late. But since most state revenue is from sales and use and not from income, which lags inflation, the impact on state revenue may be minimal.
Thank you.
As we start to look at our revenue forecast, I want to share with you what our basic assumptions are in terms of where we think the state revenue collections are going to go. First, as I think the consensus is, and certainly after Ms. Grafey has spoken, we do feel that the Federal Reserve Board will continue to pursue the goal of reducing inflation. Nevertheless, inflation, we feel, will remain high relative to recent years. Secondly, we feel that the supply chain problems will continue. I took the liberty of speaking with our supply chain people at the university before we came up here. And they are concerned that we will continue to see problems, even though there are goods and services that are coming in that were restricted before. We believe that petroleum prices will remain high throughout the 22 and 23 fiscal years. We see no inclination on the part of the OPEC nations to increase petroleum supplies, and the president has expressly indicated that there'll be no more drilling in the United States. We feel that the dollar will continue to remain strong as it has now, which will put downward pressure on exports, Tennessee's producers. And finally, we feel that there will be an economic downturn, possibly beginning in the second half of 2020. We don't know how severe that downturn is going to be, nor how long it's going to last. But we do feel that when we get into the planning process, it is incumbent upon us to recognize this is a possibility. Literally, one of the things that we're trying to do is we're trying to figure out what's going to happen with our continued revenue growth path. And as you can see from this particular slide, with the onset of the federal policies and monetary infusion of $4 trillion, we had a sharp increase in the slope of our revenue collection graph. And I've just put in here, for the sake of argument, what I term a growth path gap between what has historically been our growth path and what has been the growth path since this federal intervention, since the COVID crisis. Everyone has mentioned inflation. As everyone else, we consider that inflation is going to be an extraordinarily important aspect in what's going to affect our revenue collections. You'll notice from this BLS slide that two of the areas that inflation has remained relatively high in, and consider that it's probably going to food prices and energy prices. The increases in food prices probably going to result in the reallocation of some consumer budgets within the reallocation from consumer goods, which carry a 7% tax rate, to the lower taxed food purchases. That'll have some effect on sales revenues, nominal sales revenue. Energy prices are going to affect everybody. We expect that energy prices will continue to be relatively high, and they will cause prices of many goods and services to be bid up. It's also going to bid up the cost of doing business with the businesses not only within Tennessee but nationally. With respect to gasoline prices, that's a relatively price inelastic commodity. That means that people will still have to buy gasoline. Once again, they're going to be reallocating monies from consumer goods to gasoline, which is going to affect some of our revenues. It's also going to affect us when rents are bid up, because they're going to be reallocating their budgets there as well. Even so, several of our major revenue streams have remained strong and continue to remain strong. For example, here's a seasonal plot from sales and use tax. As you can see, our collections are much higher monthly than it has been over the previous years. It's just following the same seasonal trend as it has been. Likewise, our finance and excise taxes have remained relatively high relative to previous years. However, some of our tax sources have been impacted negatively. Of course, we have lowered the registration fee, which has resulted in about 120 reduction in total revenues in the state. We also have noticed that there has been some softening in the privilege tax, which is to be expected. As you can see, our forecast is for sales taxes to increase and for gross revenues, or excuse me, gross, or total taxes to increase in the state by about 6.24% for the next fiscal year. Keeping the idea that a recession may materialize, nevertheless, we think that the earliest that it will materialize is probably going to be the first quarter of next year, calendar year, and that we will have booked much of our revenue anyway by the time. Certainly, if it hits in the last quarter, we'll have booked most of the revenue. So there's going to be relatively good growth for the next fiscal year. It's the following fiscal year that we have some doubts about. We feel that Tennessee is still a strong economy, as everyone has said. We feel that there is going to be growth in the nominal sales tax and sales tax collections. I'm a little bit uncertain about finance and excise taxes because I'm worried what's going to happen if the inflation rates remain high and the cost of capital is high, that some of the producers and major employers are going to reevaluate some of their expansion plans and maybe pare back. Excuse me. And as you can see here, we have laid out what we feel is going to be the allocation of the current fiscal year for our major revenue funds. And we stand ready to answer any questions that you might have.
Thank you to all of you for your presentation today. And Dr. Smith, I can't remember the exact word you used. When you talked about an economic slowdown, you said it was, I think you said it was possible. Do you believe it's probable?
I personally do. Now, probable, is it 100%, 90%? I'm not that confident. But I think that there are many forecasters who certainly put it above 50%, maybe 70%. I'm a little bit mixed on it.
I know that you all know Tennessee is a long state. Where I live, where you live, we live closer to Toronto, Canada than Memphis, Tennessee. That's a fact. Do we, in essence, have multiple economies in Tennessee? You know, Ms. Grafey's from Nashville, Dr. Bruce is from Knoxville, you guys are from the Tri-Cities. Do we have different micro economies in Tennessee based on geography that may feel the effects of an economic downturn differently? And I know this question kind of out of the blue, but I mean, how would you say those different areas would experience things?
First of all, and I think that everyone is really the engine of our economy. As we look to the test, we certainly do find strikingly different ecosystems. Some of the rural counties that we have are totally different than what we see here. Nashville is an entirely different animal from everybody else. Look at Memphis, for example. They have an entirely different situation that they're facing. Certainly, as you move up, many of them are in a terrible situation. To answer your question, yes, there are multiple different experiencing economic growth. Nevertheless, many of our MSAs, as Steve pointed out, for example, has had strong growth. On the other hand, is a little bit more problematic. Yes.
Thank you. And my final question before I open it up is, when Dr. Bruce made his revenue projections, he indicated that he felt like his projections were conservative. Would you say that your projections are also in that vein? That's true. That's true. Very good. Thank you. Members, what about other questions or comments? Yep.
I'll also point out that elevator survey. So we talk about the employment situation. Last night when I got on the elevator, there's a pilot from Southwest. They're talking about it. Happened to get into a conversation. They're talking about going on a strike. So we need to be cognizant of the fact there are going to be some discussions among our, it's not only about, but some industrial action is something that we have to. And this morning when I got on the elevator, they're having a real estate convention across the way. So that's a bunch of really unhappy. Just to share with you. Thank you for allowing us to be here. It's been a
Thank you
pleasure
all.
as usual.
Thank you all for being here. Thank you. Members and guests, at this point in time, we've been here for an hour and 45 minutes. We're going to take a very strict 10-minute break. 10-minute break. The restrooms are around the corner. The snacks are right there. We will start back with the Department of Revenue in 10 minutes sharp at 10:55. 10:55, Department of Revenue's up. Thank you. Of Central Time, welcome back to the State Funding Board. We have up next presenting the Tennessee Department of Revenue, led by Commissioner David Gerigano. Commissioner Gerigano, you are recognized, and please introduce yourself for the record and your team.
Thank you, Mr. Com. Today is Jeff. And really appreciate the opportunity to be. Also appreciative of all the work.
And presenters, if you will, Commissioner, if you'll now mute your mic, that's one thing we're learning, just have one mic on at a time. Thank you. You're recognized.
Thank you, Mr. Comptroller. Pleasure to be. Revenue forecast. Been very interesting time to be a forecaster, less to say the least. So if you think about this, elephant, same as inflation. It really has been driving a lot of our revenue. Have about 60% of our revenue from sales and use tax, and that's just directly. But this is a double-edged sword because all of the things that government does with revenue has gotten more expensive, and so we need to think as we get farther into this and talk about what look like some pretty big growth rates, kind of temper that and think about them in terms of what they really would be in an inflation adjustment sort of sense. Some of the other keys, lots of these have been talked about, and so I won't beat a dead horse too much, but housing markets are slowing down. Job markets very tight, and we think will remain tight. And we're also getting sort of mixed signals about how likely a recession might be in the next year. But with all that said, our fiscal year 23 forecast is a significant revision over last year. I think that the initial presenter this morning said nobody would have predicted that demand stayed as high as it did, but it did. Consumers kept consuming, and the things that they bought got more expensive. So, year to date, the first quarter of the fiscal year, we're up 9.9% year over year. And so we expect growth, but we think that will slow down a little bit to a more reasonable rate, but reasonable rate on a really high base to begin with. This is just a little look at fiscal year 22 tax revenue. Came in
stronger than expected, again, consumption slow down when we thought it might. Sales and use tax was up 15.5% in 22, and that being 60%. A big. Sounds like I'm cutting out. So again, this slide we've seen hasn't changed very much. About 62% of total revenue from sales and use tax. Yeah, thanks. Am I good there? 19% franchise and excise tax, over 80 streams. And that's a very familiar chart. Hasn't changed much at all. Another sort of classic chart that we like to put in here and really telling is about volatility, and volatility of these different revenue streams is different. And you can see that really the line up on top that's really high, that's our franchise and excise tax. For taxes are just sort of notoriously hard to test. They depend largely on corporate profits and revenues everywhere, and then a piece of that gets apportioned to Tennessee. And so the amount of revenue that we collect isn't necessarily tied to activity in Tennessee. It's how are they doing everywhere, and then we get a piece of that. So that behaves in unexpected ways sometimes. Back to our friend from the first slide, and you've seen versions of this all morning, but inflation has been, at least in recent memory, this is historically high, and we expect that it will eventually return to something like a normal level, but it won't happen right away, and it will continue throughout this forecast period. And what that does is, as it slows, revenue growth, will slow most directly in sales and use tax. So one of the things that is interesting, and we've heard a little bit about today, is how Tennessee might be performing slightly different from the national economy. And so this chart just shows kind of a couple of trends, right, in U.S. GDP, where we had one growth rate that we were on a path prior to the Great Recession. And after that, it's just a lowered path. I mean, we did not get back up onto that trend of GDP. It shifted downward. But not so much with the COVID recession. We're kind of back on that path, that post-Great Recession, but pre-COVID trend nationally. But in Tennessee, we've got a very different picture. This is Tennessee gross state product. And we see that post-Great Recession, Tennessee sort of came roaring back and got, up above that trend that we'd been on previously. And kind of again, post-COVID recession, where we're sort of well ahead of even that trend. And so, I mean, there's some evidence that just in general, Tennessee is performing very well economically. And you can't necessarily say that we would do as well through and after the next recession, whenever that does come. But just looking at the last couple, have done better than the national average. This slide is one of the indicators that goes into a couple of the indicators that go into our sales tax forecast. And you can see something, and I think a version of this chart was directly in a previous presentation. But what you really see is that as COVID hit and people shifted their consumption the top two lines, which are durable and non-durable goods, personal consumption in Tennessee, shifted upwards and grew at a faster rate than they had been, but those have leveled out. And in the shaded area, the forecast period, they're forecast to be much flatter than they have been the last 2 years. But the bottom line, services, was down lower longer and is now sort of returning to that pre-pandemic trend. And so I think that the shifting mix of consumption from goods to services that are not taxed as often as goods is another factor that will impact sales tax revenues. Employment, I won't talk too much about. We're above pre-pandemic employment levels in terms of just the number of people employed. We use Moody's forecasts for a lot of our forecasting, and they've got this sort of flattening out, leveling a little bit, but not going down. A little more worrying, and has been mentioned, is some of the housing related data that we're seeing. These two charts are, the top is multifamily construction and the bottom is single family housing starts. So what we have is, in multifamily particularly, we were having housing starts at a very high level, and that has just dropped dramatically and is forecast to stay sort of flat to downward trending. Single family had been high, not as high as the kind of housing crisis, housing bubble sort of terms, which is probably good, but again, dropped dramatically. But in the forecast, sort of recovering some of that strength. And housing supply and demand imbalances are something that lots of the other presenters have talked about, so I won't get into, but it's certainly driving our privilege tax down through realty transfer and realty mortgage tax. And a couple more of these, the sales tax associated with building materials is actually doing really well. We are up last 6 months compared to the same 6 months a year ago. We're up about 15% in building materials. But over the same period, also up a bit in realty transfer, but on the whole, realty mortgage tax is actually down over that period with some really strong declines in October was down about 25%. So we expect that not to continue at a negative 25%, but it certainly is backing off of those highs that we had been experiencing. This slide just we're not using any significant non-recurring items or changes or tax changes in our forecasting. Gets us to kind of the real thing that we're here for, right? We don't think this is a whole lot different from what we've seen previous presenters. What I would, call our attention back to is the inflation issue, right? I mean, if we're forecasting now for FY23 sales and use tax growth of 8.2%, but over that time period, we're forecasting average inflation of about 5.9%. In real inflation adjusted terms, that's not very much growth. Most of it is explained by inflation. And the same, strong growth in franchise and excise tax this year. We're right now, franchise and excise tax through the first quarter up about 26% over last year. And notoriously hard revenue to forecast. Our overall growth we're forecasting about 7%. Again, if we think about that in terms of 5.9% inflation, 7% growth is not nearly as strong as it might look just at first glance. Then further slowing to about 3.8% for fiscal year 24. And with that, that's the last substantive slide that I have. So I'd be happy to answer any questions.
Very good. Thank you all very much for your presentation. One question, or two questions really. Number one, just as we've talked about with the previous presenters, as you look down the road, as you see what you see, what thoughts do you have about the potential for an economic downturn in the next calendar year? Do you have any thoughts or opinion on that?
So I'll say that our forecast does not include a recession in our sort of baseline. Absolutely, there is a risk. I won't speculate on timing. I think qualified, but it is a real risk. And how that works out nationally and how it works out in very uncertain.
Thank you. And, Dr. Smith, the last presenter, talked about a unique phenomenon that we have here in Tennessee, where inflation in the short term drives up revenues. But you reach a point where inflation becomes so pervasive that consumers start to have to make a choice about what they buy. And the thing that I have found about most people is they like to eat, as a general rule. And so they have to buy food. And so they begin to shift their purchasing, more. They keep buying food, which we tax at a lower rate than general merchandise. And so do you see any trends? Are you able to track that type of phenomenon in your department? And do you see any trend right now away from purchasing other goods and moving towards the lower tax, just because inflation's high and people don't have as much money to spend on the extras? Or would you anticipate that shift happening, in the next calendar year?
We are not currently seeing a reduction in those sort of consumer goods we forecast those separately, actually, because they're different kinds of spending. But in our actual collections, we're seeing strong growth in many of the goods related sectors. Tourism was mentioned earlier, and we've got really good, almost 15.5% growth in eating and drinking places. So, and about year to date, 5.5% growth in car sales, and a lot of that is price, right? But we're not yet seeing that slow down or shift in consumption.
Thank you. Members, what about other questions or comments? None? Mr. Treasurer?
Commissioner and Jeff, is the Department of Revenue still taking into income and collections all of the amounts that are received under the franchise and excise tax, include estimates included in that? Is that what your current practice is still?
Yes, sir.
Y'all track in any way how much of that ultimately could be claimed in terms of a refund or an adjustment when the return is actually filed and all the later date? Of course, I'm getting at, Commissioner Giordano knows what I'm getting at, because we've talked about this before, is that, during the 08-09 downturn, when we came here, we found it pretty painful, to have taken into income all those F&E tax collections and everything, and then later had to refund a bunch of them at a downturn that occurred because these companies had extended their returns. I just wondered about how we're accounting for that these days.
Thank you, Mr. Treasurer. The accounting is the same as it has been. When a company makes their quarterly estimated payments throughout the year, counted as collections at the time received, and then they file a return some months later, either 4 to 10 or 11 months after the year. And there is sort of a balance that carries forward. And if their return liability is less than the estimated payments they made, then they have a choice to make at that time. They can take a refund, or they could simply carry that balance forward to the next year. And that's basically a credit on their account, if you will. And it's been counted as collections already. And it's around 700, 800 million that's typically carried forward each year. So that's always in the back of our mind. So that behavior change, for example, as interest rates go up and the cost, there's money's more expensive. Well, people make different decisions on whether to carry that forward because we're not paying them interest, right?
Right.
And so will they make a different decision and in essence draw down a little bit more of that credit than they have back when inflation was, or I'm sorry, when interest rates were. So that's always in the back of our mind.
So one of the things, and this is that if you're a controller of a company and you're filing an F&E tax return, you just want to make sure that you've estimated 100% or 100+%, because you don't want to be caught short and having to pay interest, if you were under the correct amount and everything, because the department's statutory interest rate is greater than what the market was paying during many of the low years for interest and all that. But it is, you say the dynamic is changing some, but I'm still concerned about state government, having to, at the future, cough those back up. So, maybe David Thurman will take that into account in this year's budget. We'll correct that.
Again, any further questions, comments? If not, we thank you all very much, as usual, for being here. Great job, and we appreciate it. Next up on the agenda today, we have the Fiscal Review Committee. Boyan Savage is here, and I'll let you come up and be recognized and introduce your team that is with you.
Mr. Comptroller. Name is Boyan Savage. I'm the Assistant Director of Fiscal Review. Joe Wagenka, he's our Chief Economist. Thank you again for the opportunity today. We'll try to keep our remarks relatively brief, as a lot of what we've prepared has already been covered by previous presenters. I'll turn it over.
Thank you, members of the Funding Board. As Boyan mentioned, I'm Joe Wagenka, Chief Economist of Fiscal. As you know, we had strong growth in FY22 over the previous year. And right now there's the question of recession. While we've seen some signs of recession, and we think with the Fed's action to combat inflation, a mild recession is somewhat likely in 2023. However, the economy and people's balance sheets are in better position than past recessions. In Tennessee, we continue to see migration into the state and business and employment growth. And finally, we'll look at the impact of legislation on our estimates. Real GDP did see the 2 consecutive quarters of negative growth, but most recent quarter estimates are around positive 2.6% growth. Looking at the 10-year versus 3-month yield spread, historically, when this metric drops at or below zero, we are nearing a recession. And looking at daily rates, this number has been right around or below zero over the past couple weeks. Inflation continues to be a concern. We've heard about the Fed's action and expectations around further rate hikes. In Tennessee, this is a couple different impacts. As prices go up, sales tax collection should also go up. But as people spend more on rent or necessities like food and gas that are taxed at a lower rate or not at all, that leaves less money to spend on the higher tax goods. For businesses, this means shrinking profit margins as the cost of parts and labor go up. And looking at the stock market, this has actually shown some strong increases this week. S&P has added almost 200 points to the number we have here. Signs that inflation may begin to be easing and Fed may not be as aggressive with future rate hikes in 2023. And looking at employment, initial unemployment claims are relatively low at just over 200,000. While historically cause for concern of an imminent recession is when this number reaches around 350,000. Comparing overall employment to previous business cycles, we continue to outperform previous cycles. This chart shows employment growth leading up to and following the peak of each cycle. So our month zero here is December of 21, which was followed by those 2 consecutive quarters of negative growth. As you see, we've well outperformed the previous cycles. And others have mentioned state level employment. As they've said, we've recovered much of the losses and seem to be back on trend. And looking at hourly earnings, Tennessee continues to rise, which of course goods for sales and many other, which is good for sales and other tax collections, but makes the cost of doing business much more expensive.
Switching over to industrial production. Industrial production covers manufacturing, electric and gas utilities. And this sector, together with construction, accounts for a bulk of the variation in national output over the course of the business cycle. As you can see here, industrial production tends to fall significantly during recessionary periods, and currently we're at relatively levels. This is that same graph that we've just seen a minute ago. Essentially, what we're trying to see is how do we compare currently with, in this case, industrial production relative to previous downturns in the economy. We've set our peak of the current cycle at December 2021, just because we've had 2 consecutive quarters of negative GDP growth in this calendar year. So we were essentially trying to see, have we seen any kind of a downturn in this metric? And does that downturn follow the path that we typically see during recessionary periods? And similar to the picture with employment, you can see that currently we're in significantly worse shape than we are typically in an economic. But we've talked a lot about housing. Housing is certainly a sector of the economy that has entered a downturn. It is a direct result of actions at the federal level. Housing market represents a very significant driver of our sales tax collections as well as our privilege tax collections, and there are a lot of multipliers that come along with spending on housing. We're all aware of the significant increases in mortgage rates. We're currently sitting at over 7% for a 30-year mortgage, and these rates are higher than we've even seen in the Great Recession. Largely due to these high mortgage rates, home sales, housing starts, and builder confidence has cooled. Higher financing costs have significantly worsened the affordability of homes, despite some recent moderation in home prices. New home sales are currently about 18% lower than last year. Existing home sales fell for the 8th straight month in September. We're at about 24% lower level than previous year, and this is the slowest pace that we've seen. As we already mentioned, home prices are starting to moderate and are expected to continue on this downtrend for some time. Since the start of the year, existing home sales months of supply has doubled. So in January, we were at 1.6. Currently, at September, we're at 3.2. And this is a metric that tells us how long would it take to essentially deplete the current supply of existing homes relative to the price of homes. One thing that we want to note here that we think is very important is that most homeowners have a significant amount of equity and will not be underwater even if these declines continue for some time. And this is vastly different from what we've seen during the Great Recession, where millions of borrowers had little to no equity even before home prices started to decline significantly. So we're relatively certain that any further downturns in the housing market will not be similar to what we've seen during the Great Recession. We've seen this chart a couple of times today already, so we'll skip it, but we just wanted to include it kind of as a more of a localized picture of the economic downturn. Household debt service as a percent of disposable personal income remains at historically low levels. Seen an uptick in this metric yet. Once again, here's the chart that we've seen a couple of times. As we all know, government transfers represented a very significant boost to personal income over the last couple of years. Just this morning, the Bureau of Economic Analysis issued a report showing that personal income increased in almost 99% of counties nationwide and all of counties in Tennessee in 2021. But even when we remove that, those government transfers and we just focus on personal income, less government transfers, and look at that at real term, we're still seeing slight growth. Very low growth currently, about 0.5, 0.6% year over year, but still some growth. So this chart is not showing us as clear of a picture as the employment and industrial production chart had relative to previous recessions, but we're still slightly above the average of those downturns. Switching to the auto sector. We've talked a lot about today about the impact of housing and the auto sectors on our sales tax collections. While I want to reiterate the impact of the housing downturns and our collections, and particularly state sales taxes and privilege taxes, the impact of the kind of the negative developments in the auto sector that we've seen is not as great on our sales tax collection. And the reason for that is while we've seen these extremely low inventories, at the same time, the result of that was significant increase in vehicle prices. So currently new vehicle, average price of new vehicle is about 20% higher than we've been at pre-recessionary levels. And for used vehicles, that's about 50%. Borrowing costs, of course, have increased that have impacted this sector as well. And as a result of all of that, light vehicle sales have been down significantly over the past. We collect about over $1 billion in sales tax collections on average, just from motor vehicle dealers alone. What's interesting is that our state sales tax collections from these dealers have continued to increase over the last several years. And the reason for that is that while we've had this significant decrease in vehicle sales, we've also had that increase in vehicle prices that has been more than sufficient to offset negative impacts on our sales tax. While these numbers are not included in our presentation, the impact that we would likely see from these developments is in the local sales tax collections, as the local sales tax rates are limited to the first 1,600 of the purchase price of any single item. So any offsetting impacts of these price increases would not be seen in the tax collection. Here we see the small business optimism and consumer sentiment. Consumer sentiment is at historic lows, but despite that, consumer spending has been very strong for the last couple of years, and that's in large part been financed by stimulus payments, low savings rate, and more recently increased credit card debt and home equity lines of credit. For example, home equity lines of credit and traditional home equity loans have increased by nearly 50% over the first half of this year relative to this year. For the small business optimism index, we've now had about 10 consecutive months of readings below the long-term average of about 98. However, it has not declined as significantly as consumer sentiment. I will point out, kind of going along with everything that you've heard today, approximately a third of business owners report that inflation was their single most important. They continue to show somewhat of a dismal view about future sales growth and business conditions, but are still looking to hire new workers.
So some important notes, in July, we had the traditional sales tax holiday. And then in August, we had a one-time sales tax exemption for the entire month on food and food ingredients. The net impact of this was reflected in September collections and was a decrease of about 50 million in state revenue. The motor vehicle registration fee was waived for Class A and B vehicles for all of 22 and 23, which will result in about $121 million going uncollected. And then privilege tax positions were removed from the list, which will result in a permanent decrease of about 9 points. And looking at sales and F&E year to date, we've seen about 10.7% growth in sales tax, which if you account for the food exemption, the growth rate is actually around 12.3%. For the remainder of the year, we're forecasting 7.8% growth. There's still a good amount of growth, but much lower than the 12.3% that we've seen. Franchise and excise is at 18.5 year to date. But with our largest collection months still to come and some uncertainty in collections, we're estimating a lower 6.37% for the remaining months. And this chart just shows how we would need collections to come in the remaining months in order to hit our total forecast. So as you can see, we expect a couple months to continue some high collections, but overall we expect to see those growth rates decline quite a bit relative to the rates we've seen. And then just summarizing our overall outlook, we expect continued growth in 23-24 for sales and F&E, but at lower rates than what we're seeing right now. A mild recession may be likely, but the economy is much more stable than prior to the previous recessions, and we expect inflation to begin easing in 2023. And more people means higher tax collections. Tennessee ranked 8th overall in population growth last year and 6th in net domestic migration into the state. And then just a reminder that expiration of tax and fee exemptions will lead to an additional collection of over 185 million in FY24 compared to the current year. So looking at our estimates, we have sales tax collections growing at 8.5% for the year and slowing down a bit next year to 4.06%. Privilege, we have down 6.2% in the current year, the additional exemptions and decline in real estate transfers, but expect that to rebound some next year with 7.7% growth. F&E we have at 8.6% this year and 5.35% next year. And then I'll just point out again the current year exemption in motor vehicle registration with next year back to normal year of collections. So that gives us a total increase of 6.62% in the current year and 4.65% in 24. And that brings our general fund estimate for 22-23 to 19.3 billion, or a 7.2% increase. And then comparing it to the current budget estimates, we're estimating an additional 2.79 billion in total collections and 2.66 billion in general fund collections. And finally, for 23-24, we're estimating total general fund collections of 20.2 billion, represents a 4.6% increase over our current year estimate. And with that, we'd be happy to answer any questions.
Very good. Thank you. Thank you very much. I was going to lead with my question that I'd ask everybody else, which you kind of already answered about whether or not you felt like there was going to be an economic downturn. And you said yes, but perhaps mild. And you pointed out the economy seems to be more stable than previous recessions. Members, what about other questions or comments? Anyone? Commissioner?
I think I missed a number that you mentioned. So what was your, general fund forecast for 24? FY 24? Did you say that? Because I don't see it in here and I missed it.
Yes. Total general fund collection of 20.2 billion.
Was that a percentage
That's
increase?
a 4.6% increase.
Okay, thank you.
Members, how about other questions? Comments? Okay. Thank you all very much. Don't go anywhere. So members, that, and guests, that concludes the presentations in regard to revenue estimating. We're going to make the transition now into lottery revenue estimating. It's always a gamble. Starting off, thank you for that mild laughter. We're going to start in regard to the lottery revenue estimating, again with fiscal review, and you are recognized.
Members of the planning board, thank you again. I'm Joe Ganka, Chief Economist with Fiscal Review. And again, joining me is our Assistant Director, Blaine Savage. In FY 21-22, net lottery revenue decreased by about 2.82% after 2021 year that had large growth. Total expenses decreased by 2.71% for an overall decrease in net lottery proceeds of 3.13%. Instant ticket sales made up about 83% of total sales, while Powerball and Mega Millions made up a combined 7.6%, with Cash 3 and Cash 4 making up a combined 6.5%. First quarter of the current year, we've seen almost 1.2% growth in net revenue, 0.6% growth in total expenses, and 3.1% growth in net proceeds compared to the same period a year ago. Overall, instant games were down a bit last year, but that was over larger than normal gains in 2021. So expect that to come back towards the trend line over the forecasting period. Our instant games gross sales median estimate for FY23 is 1.65 billion, which assumes a negative growth of 2.4% over FY22. Our median estimate for 24 assumes an additional 35 million sales on top of our estimate for 23 for a growth rate of 2.1%. Looking at Powerball and Mega Millions, sales for both games are driven by jackpot amounts, both reset at $20 million jackpots with increases based on sales and interest. In August of last year, Powerball added a third drawing a week, a feature called Double Play, offering an additional prize up to $10 million. Powerball saw 28.1% growth last year, likely driven by some of the changes to the game. We recently saw a record high jackpot of over $2 billion, which led to multiple weeks of higher sales. So we're estimating 128 million for the current year, driven by that higher jackpot amount, and 91 million for next year. So that number could certainly be much higher if we see additional higher jackpots. Mega Millions was down 35% last year, but that was over a year that saw a jackpot in excess of $1 billion and only had a highest jackpot of just over 400 million. Year to date, we've already seen a large jackpot of over 1.2 billion in Mega Millions, driving sales higher earlier in the year. So for this year, we're estimating 69 million, driven mostly by that higher jackpot, and estimating 60 million for next year. And looking at other games now, I'll mention that there is a new draw style game, the Tennessee Daily Jackpot, that just launched this week with jackpots starting at 30,000. We did not forecast this game, but we don't expect this to significantly impact our total estimates. We do expect this game to cannibalize some other sales like Cash 4, for instance. And we plan to have a forecast for this the next time we present. Cash 3 and 4 were down 3.2% and 4.5%. We're forecasting that those will remain relatively flat, down slightly in the current year, about 1.8 million, leveling out slight growth of 1.9 million, 23-24. Tennessee cash was down 17.8% last year as it continued to decline. We see that one rebounding slightly this year, but remaining flat in 23-24. Cash for life was down 9.6% after a previous year of 21.6% growth. We expect 2.8% growth this year and flat in 23-24. Lotto America grew over 7% last year as the jackpot grew throughout the year, and we still have not seen a winner in that one since July of 21. So we're expecting around 20% growth this year and then back to normal sales numbers next year. But these numbers could be much higher if the jackpot continues to grow without a winner. Finally, Keno to Go saw a drop of about 10.6% after 20% growth in the previous year. We expect further declines of about 6.5% this year, flat next year. Then looking at our total 23 estimates, we have net lottery proceeds at 468 million, an increase of around 0.2%. And for FY24, we have a median estimate of about 464 million, which is down slightly after some record jackpots in the current year. But again, in the event we see more record jackpots next year, we expect this number to be higher. And looking at future years, forecasting further out is difficult due to multiple unknown factors like new games, changes to games, legislative changes, and jackpot cycles. But we're estimating growth of approximately 2% next year for the next 3 years, beginning in FY25. And then finally, this graph shows actual net lottery proceeds with our median estimate for the 5-year forecasting period. So as you can see, we have slightly slower growth, but positive growth in future years over previous years of higher growth. We'd be happy to answer any questions.
Thank you very much. Members, any questions or comments? If not, we thank you for both presentations and thank you for being here. Up next on the agenda in regard to the lottery revenue estimating presentations, we have Rebecca Hargrove, President and CEO of the lottery, and we will let you introduce your team that is with you. Thank you for being here.
Thank you all. With me is Andy Davis, who's been our CFO for 19 years. And we're happy he's here, and it is a pleasure to see all of you. We'll be short and sweet. Most people since a week ago have been asking me about the impact of the $2 billion jackpot. So let me give you just a couple of highlights on that. In an average week, we'll do 1.6 million in sales in Powerball. And the last week of that run, we did 24 million. So the difference in just 1 week in Powerball with a $2 billion jackpot makes a difference. We had one winner of the grand prize, but here in Tennessee, we had over 233,000 people win something in that last drawing, including a $500,000 winner in Murfreesboro, 2 $100,000 winners, and 2 $50,000 winners. So there were multiple winners across the state. That 233,000 was just in Tennessee. I would like to address a little bit last year's numbers. It was our second best year ever, even though you just heard there were some declines in some games over the previous year. The previous year was really an anomaly in the COVID years. You had other entertainment sources that were closed because of COVID. So we tracked our sales growth in that abnormal year, and they were across from Tunica, which had been closed down. So people who had been driving to Tunica stayed home and played our games. Same across the Kentucky border, where you had either casino shut down or bingo hall shut down. So we had an abnormal year in 21, but sales last year, even though they were down from the year before, were up 16% over 2019 and 25% over 2020. So it was, as I said, our second best year ever, even though the numbers you just saw said slightly differently. Let me just address for a moment creation to date numbers. Gross revenues since we started are 26.8 billion. We've raised 6.6 billion for the education programs that we fund. There's been close to 2 million students who have benefited from the dollars we've raised. We've increased sales on an average of 5.3% annually for the 19 years we've been in business. And let me take for an example our instant game product, which is 80% of our sales. Our first year, full fiscal year in 2005, our sales from our profits from that game were 153 million. Fast forward to last year, they were 355 million. So instant ticket growth in revenue or profits you spend, 153 our first year, 355 our last year's. Our lottery for education proceeds have grown on an average of 4.3% annually, which is far above the national average. So with that, I'll turn it over to Andy to go over next year's numbers, and then we'll answer any questions.
Good morning. I guess it's still this morning. In terms of the fiscal year projections for estimation of net lottery proceeds, Tennessee Lottery, the first area in terms of where we are through October, in this case November 5th, I'm sorry, on the report, Tennessee Instant Games, Tennessee Online Draw Games, and Tennessee Multi-Jurisdictional Games are the three major categories of games that we track. And as of fiscal year through November 5th, we've had 731.5 million in gross revenues for this fiscal year to date. This was not updated for the most recent week that Rebecca mentioned, where we had the $2 billion jackpot for Powerball 1, and that week would be in addition to the 731 million. In terms of the driving force significantly for us, is going to be instant ticket products, as Rebecca mentioned. Instant ticket games generates approximately 80% of our sales. For this fiscal year, we're projecting it to be about 81% of our sales. June 30th, we're projecting revenues of our instant product of almost 1.65 to 1.69 billion this fiscal year. To accomplish that, we're looking to launch about 55 games from $1 to $30 for this fiscal year. Ticket products. Those include our most significant the revenues for those games driven primarily by the game design, player preferences, payouts, product marketing, and our optimizing our availability into our 5,000 retailers. Next area of larger sales for us is our Tennessee only Draw Star games. Those are Cash 3, Cash 4, Tennessee Cash, and Keno to Go. And as mentioned in a previous presentation, launching our daily Tennessee jackpot game that started this past Sunday. Those games we project to be about 8.1% of our sales this fiscal year, with a range of 163.8 to 166.3 million this fiscal year, with Cash 3 and Cash 4 being the most significant components of those sales of about 127 million. The third category that we track, those include Powerball, Cash for Life, and as you look at the chart that's on the screen, you will see that when we have a significantly large jackpot, we do 1.6 million on the average cycle. This draw cycle, almost 4 million on the Powerball jackpot cycle from August all the way through to the jackpot being won in November. We expect our multi-jurisdictional games to produce about 11% of our sales this fiscal year.
with those sales being between 218.7 to 221 million this fiscal year. Powerball being the most significant of that this fiscal year with a significantly large jackpot of between 120 to 123 million this fiscal year. In terms of Mega Millions being our second largest product in that category, we project revenues of between 70 million and 72 million. On a normal weekly jackpot cycle for that game, you would do about 900,000 a week. During that jackpot cycle that ended in July at 1.2 billion, we averaged 2.5 million a week over that entire jackpot cycle. Our third multi-jurisdictional game is Lotto America, and we're projecting about 15 million this fiscal year for that game. And then Cash for Life, which is estimated at 13 million. In terms of the direct expenses that we project for the fiscal year, our budget includes the most significant being prize expense. Prize expense is estimated at 1.22 to 1.25 billion. Instant games payout as a total of lottery proceeds projected at 68%. And then the Tennessee draw games projected at 50.3%. And then multi-jurisdictional draw games at 51% total lottery proceeds. The next area is retailer commissions. Retailer commissions as a percentage of gross sales at 6.5% would be between 132.7 to 135.6 million. And our major gaming vendor fees as a percent of revenues at 1.8% between 36.1 to 36.9%. The two major vendors that are captured in this category is IGT, who provides our systems and terminals at retail, and then Scientific Games, who provide our instant game printing and distributions. The other categories in the non-direct area would be at advertising at 8.1 million, our non-direct gaming at about 6 million, general administrative at 23 million for the fiscal year. Our gross ticket revenues, we project this fiscal year at 2,033 million to 2,078 million. Our total lottery proceeds estimates being in a range of 1.89 billion to 1.94 billion. When we look at our education funding, we're projecting this fiscal year net lottery proceeds of 472.6 to 483.1 million, and after school program proceeds resulting from unclaimed prizes estimated at 18 million, and that is the maximum per statute. In terms of the final page of our report, we just identify a summary of the information that I provided that provides comparable to fiscal year 22, our fiscal year 23 budget, and then our current estimated ranges as discussed. When we look at the future 4 years going out, we're currently projecting conservatively at 2 to 2.5% growth, which would give a fiscal year 2024 range of 480 to 494 million. That concludes our presentation.
Thank you very much. Members, what about questions or comments? I have a couple questions. No doubt your retailer network is important to your sales because that's where the tickets are sold. What is your current retailer commission? Is it per ticket? Is it per dollar? And how much is it?
It's 6.5% by statute.
Okay. And so that's 6.5% per dollar?
Yes.
Yes. One just more curiosity than anything is when you have a $2 billion jackpot and you have $24 million in sales, how do you keep your retailers supplied with paper? I mean, what do you have enough paper in reserve anticipating something like this? And how do you get it out to your retailer network?
We have a ticket stock that's actually printed in Tennessee, and we have a whole team that looks at ticket stock weekly. And as you're rolling into that jackpot, we print more reserves so that, it was I think the jackpot cycle went from August till it was hit. So you had time to make sure you had ticket stock at every retailer location. And we have field maintenance people all over the state that deliver that ticket stock and play slips, et cetera. And then we have emergency stock in all of our district offices in case anybody runs out, we can get it to them.
Great. With the increase in inflation, when was the retailer commission, when was it last addressed statutorily?
In 2000 or in 2003, when the enabling legislation was written.
So it's been a while. We understand the inflationary pressures everyone is feeling. We understand the hourly wage rate inflation that folks that run gas stations, for example, are feeling. Is the retailer compensation commission where it needs to be, or does it need to be adjusted because of these pressures that are out there?
Well, the average retailer commission in the US is 5%, and we're at 6.5%. So we're certainly higher than the national average. Does that mean it should be addressed? You know, that's up to you.
Do you
Representative
hear that from your retailers?
I have not. The people I've heard it from are the people who provide paper because of the inflation costs of paper in all of our ticket stocks. So those are the people that have come to us and said, can you do something? And we've said no, because every dollar we would take away would come from the lottery education proceeds.
Sure. Thank you. Members, how about other questions or comments? If not, thank you all for being here as usual.
Thank you.
Next up on the agenda today, we have Tim Phelps, Associate Executive Director for Grant and Scholarship Programs from TSAC. Welcome, you're recognized. And by the way, I do want to tell you, I apologize for the mic troubles today. I should have said this earlier. We actually have a new microphone system on order. You all may have heard there was a supply chain crisis, though. It's out there somewhere on the way. I can tell you that. Thank you.
Morning, Mr. Chairman. Phelps, Senior Director for Branson. Got it as close. Is that better? I'll start over. Morning, Mr. Chairman, members. Tim Phelps with TSAC. My remarks will be brief. You should have a copy of our latest memo, which provides the estimated expenditures for our lottery funded programs. We've provided a baseline estimate for the current year through 26-27, and that current year estimate is based on actual fall expenditures for our lottery funded programs as of last week. See, our estimates have increased from last year, obviously, in out years, due to legislation that we passed during the last session to make changes to several programs, scholarship award amounts, expanded several programs. Still use the methodology that our out year estimates are based on a gradual growth, number of potential eligible recipients, the take-up rate, and then scholarship renewal. The low end of that range, it'll lower. Yeah. The low end. The low end of that range will represent a low. Is that better? Okay, I'll start over. No, I'm just kidding. So the low end of that range represents a lower take-up rate, lower renewal rate, and then the high end of that range is going to represent a higher take-up rate and a higher renewal rate. And so that concludes my remarks. Happy to answer any questions that you may have.
Thank you very much. Members, how about questions, comments? If not, thank you very much for being here.
All right. Thank you, Mr. Chairman, Board.
So members, that concludes our revenue estimating presentations as well as our lottery revenue estimating presentations. We're going to move on and hear a report from the Tennessee State Veterans Board. Come on down, Ed Harries, Executive Director, Danielle Brown, Controller. You are recognized.
All set? Okay. If not, I can always yell. Anyway, thank you for having us. Numbers I've been seeing earlier today are a little bit smaller than all of those, but nonetheless, very important to us. Starting with our presentation, you should have a report in front of you with all the detail work in it, but want to go over the highlights for you so you can see exactly what's been going on at the veterans homes and what we've got happening. First thing I'd like to go over is, we do have a slide advancer, don't we? Is our CMS star ratings. The ratings for the facilities right now, Murfreesboro is at a 3-star rating, and that's related to a citation they got in infection control. We didn't have one employee didn't sign in before they came into the building as part of our infection control program during COVID. Their name wasn't on the list, so we took a high point citation there and dropped their 4th star. We'll be chasing that star and regaining that quickly. Clarksville ran into exactly the same problem, but we have regained that 4th star on their part. Knoxville is at 5 stars and Humboldt is at 4 stars. The Clarksville building, Humboldt building, and Murfreesboro building all have 5-star ratings when it comes to quality of care and quality measures. So they're doing very well. Our Knoxville building, which is 5 stars, just one little notch below that. And it's all related to what's going on with the residents and their conditions. Moving forward, if there are any questions on that. Moving forward, this is a little bit of a busy graph here. However, it shows our occupancy over the past 13 months. As you know from last year's report, COVID hit us pretty hard with census, both with the market dropping out when people didn't want to go to nursing homes, and also we did have in one of our buildings, we had a significant number of deceased due to COVID. That was our Murfreesboro building. The census has been on the increase. We expect that we are going to recover completely. Our biggest drawback relates to a lot of what you've just talked about with other departments is related to labor. Our Murfreesboro building has hit the hardest on that. We froze on admissions, as you can see in the graph, in June, mainly because we didn't have the labor to take care of people. And in doing so, what we did is we went to contract agency staff that are brought in, which are extremely expensive. However, we have to take care of people. We've started to alleviate that now, and from July on, Murfreesboro is starting to progress. The stars there, Murfreesboro's a red line. The stars there are their census as of Monday. So you can see where they have recovered. Biggest recovery has been in Clarksville and in Knoxville. As you can see, they're up over the past 2020 budget, right at that mark. And so they have pretty much recovered in census completely. But all of the buildings except for Humboldt are currently having the same labor challenges. Middle Tennessee, Clarksville, and Murfreesboro are having the worst. The brown line on that graph is the average census for the state of Tennessee for all nursing homes in Tennessee. So our buildings, 3 of the buildings exceed that and always have. The red line, of course, is Murfreesboro, which is a little bit more challenged. The yellow line shows our budget as we reprogrammed it according to the years, and we, at this point, 3 of the buildings are exceeding their budget. Any questions there?
Members, any questions? Not so far.
No, great. Moving on, looking at our staffing, which is our biggest problem, is recruiting, retaining staff. 2 things are happening. One is in Middle Tennessee, especially, the labor market has opened up, especially for our level of CNAs, housekeepers, that kind of thing, to all industries. All industries are drawing upon our current labor pool. So we're losing employees to that as those wages go up. The other thing that is happening is with the contract agency staff, they pay a much higher premium or wage to employees, especially in our CNA pool, than we can afford. So our CNAs are going over to the contractor, which then we have to contract with, which just drives our expenses up. And that's our big target for this year, is bringing that expense down. Yes.
So how are you able to affect your salary policy in light of the market?
We did do a significant raise in the last budget cycle, and we evaluate that regularly, but to adjust our wages, we've got to do a full, we've got to submit to various state agencies. I just can't click my fingers and say, that we're going to give a significant increase. The other problem is we're also self-sufficient. So I've got to look at, do we have the money to actually afford that? What we are seeing from that contract employee ratio, though, is what's happening is we're seeing that what the contract agencies are actually paying the CNAs is becoming more in line with reality. So we may see a benefit from that. However, our cost of agency use staff is still at that top benchmark. So they've got a much bigger profit center, and of course it's hurting us. But our attraction is that we do have the state benefits. It's a much better workplace than most places for nursing homes, and our staffing levels are higher. And so we're an attractive environment for a CNA or for a LPN or RN.
Thank you.
Yeah. As you can see on that graph as well, we're consistently above the state and local state and national averages for staffing. We are, as of this past week, over four clinical staff members per patient day. Average in the nation is 3.75, and in Tennessee it's about 3.5. The state requirement is for us to be at 2.0, which is, that's dismal if we ever get to that point. And the gold line there is the national, the VA requirement, which is at 2.5. Okay, moving forward into yes, please.
I'm sorry, I just didn't follow that. So you're, you said you're supposed to hit 2.5, right?
That's the law.
And you're at what now?
We are at 4.0. The
Okay,
2.5 is the threshold to stay within the law.
And and that is exactly what's that measurement?
That's the number of clinical staff I have on board to deal with one resident for one day.
So you're actually higher than the standard.
Oh, yes.
So you're dealing with this staffing issue pretty well, it sounds like.
We are, however, that 4.0 that we're looking at is only related to the number of residents that we have in house at this point.
So you've got unfilled beds because you don't okay.
Yes,
and
I
if you
actually
filled those beds, that ratio would come significantly down.
correct. And I can't fill those beds until I get the staff to allow to give that care. The three buildings, Knoxville, Murfreesboro, and Humboldt, are all 140 bed buildings. Clarksville is 108. Okay. Moving on to construction. I'm happy to report Cleveland Bradley County facility, 108 bed facility, is right at the cusp of being finished. I was there yesterday. We're projecting in the report we had a completion late fall of 2022. That's probably going to move into December sometime from what I'm seeing. We will anticipate, I would see, a first resident coming into that building in 2024. Cost of that building was $47.7 million. And as you're aware, we leveraged a VA grant for that for 65% of that cost. Arlington, Shelby County is currently under construction. They just started pouring footers there. It's expected to be open in late spring of 2024. That's a 126 bed building, and that ticket on that was $68.8 million. Looking at other construction projects we've got going on, as the other buildings are aging, we've had to do some improvements and various renovation projects. In Knoxville, or I'm sorry, in Murfreesboro, we have a $2 million project that's adding generators to our HVAC chillers. We have done that in all of the buildings, and you'll see those on the following projects. The reason for that is that in the heat of summer, if the power goes out, our generators currently do not work the air conditioning system. Very bad situation since we've got to maintain temperatures. When they had the incidents in Florida where they had deaths related to exactly that, we several years ago, or a few years ago, we put through VA grants to fix that in all of our buildings. We've also added, as part of our disaster planning, 1,900-gallon water supplies, storage supply tanks. In case water goes out, then we have those as well. We are already required to save that much water as well. Currently, we do that in bottles and cases and that kind of thing. In this system, we have large tanks of water that we maintain, so that water will be available to us if we need it. The Murfreesboro building, also built in 1991, has its original windows, so we've had to replace windows and resin doors and things like that. In Humboldt, we have the same chiller and emergency water supply issue. So we're working on that, but they also had an internal piping issue with a lot of condensation and leakage that was occurring. So we are revamping all of that plumbing. That'll be $1.9 million, $2 million on average. Also in Knoxville, again, the chiller issue. The other issue we found in Knoxville is they only had one heating boiler. What happens there is if the boiler goes out, we no longer have heat for the building, which causes us to evacuate a building. It's a very terrible place to be. So we're putting 2 boilers in there, and that boiler was almost at the end of its lifespan. So definitely needed to be done, and that was about $500,000. We do have a project on the list for the with the VA for a grant for our executive office to expand. As we grow, we've added the current facilities are set to handle 3 facilities. We currently operate 4, and we're going to be moving up into 2 more buildings by 2024. So we have to expand our infrastructure to support those buildings. That's if we got the VA grant, if it were approved and we were doing construction in 2025, that would be about $3 million. Included in that, as well as a lot of disaster supply storage that we are currently renting storage areas to put disaster supplies and COVID supplies and those kind of things in right now. Sullivan County, we've looked at some land up there. We're currently at the fledgling stage there. We don't have any funding or a grant put in for at this point, but it is one of the unserved markets that we need to look at, but that will be down the road. I moved pretty fast there. Is there any questions on any of that?
Continue on.
At this point, I'm going to turn this over to Danielle Brown. She'll go over our finances.
Hello. I'm going to start with the cash position. And this is our LGIP accounts, and this is based on the state funding board agreement that we have with you to earmark our funds. We currently have $21 million in our LGIP funds. The biggest portion of our funds is in our operating reserve, and that is in case we deplete our revenue fund, which is where we pay our payroll and AP from. The next slide is our financial position as of October 31st. Entity-wide, we have a loss of $1.4 million. We were budgeted for a loss of $1.2 million. So that's a difference of $200,000. That is mainly due to, as Mr. Harry stated, the increase that we did was about 6% to our pay scale to increase that. Also, excuse me, as previous presenters have stated, our supplies have went up for nursing homes. And also we are incurring a surcharge on fuel. So even the lawn mower is charging a surcharge for fuel now because of the prices of gas. The agency cost is basically the difference as Mr. Harry stated, we're trying to get them out of the homes. They weren't included in the budget, so we are working very hard at doing that, and that is a very large expense for us. That concludes my report. Are there any questions?
Mr. Treasurer? You're not on there. Try, hit your button again. There you
All
go.
right, we on now? Okay. On your budget deficit there, what would be the case in terms of that if you had every bed filled and because you're running with a certain occupancy level that's probably below the optimal level you want to be at in some of these homes. And so what does it look like, do you think, if you are able to run at the proper occupancy level?
I think we would be at a profit. It just depends on where their staff come from. If there are staff, we definitely would be at a profit. With the agency staff, an RN, we're paying about $100 an hour for an RN versus our cost would be about $40 for that RN. So it's almost double.
Well, I mean, have you looked at the costs of the staff to see whether you, even with those additional costs, you think you could be at a profit if you had the occupancy that you needed?
I guess our main goal is quality of care. So we want to stay at that 4.0. And so with the budget cycle, like for example, Murfreesboro would be at a profit if we didn't have the agency costs. Clarksville, just because of the structure of the home, their houses instead of the units. So we have to budget based off of each house. So just because of the layout of that home, they wouldn't be profitable, but the other three would be.
You mentioned that you had a budgeted use of your reserve of $1.2 million here. Sheet here, that difference of 196,000, but you know, you've got your operating reserve. You said it was $21 million in your cash position. You got 38% of that in your operating reserve. And you'll eat that reserve up eventually, unless of course the state supplements it. So
Yes,
what's
sir.
the plan going forward?
We're trying to get the agency out of the homes. If not, we have the 31% in the operating reserve, in our revenue account, which is about $7 million that we are using to pay for these costs. This far, we haven't had to dip into those funds. We were able to make it through COVID without dipping into it. It kind of got close there for a minute, but we were able to not use any of our operating reserve. And $1 million of that in the operating reserve is for startup for Cleveland.
Well, it's a tough time to run a facility like this, but as y'all have described in terms of the costs that you're having to deal with and other additional issues, but something to look at for the longer term. Thank you.
One quick question on an average day at this point in time at your levels, how many humans are you serving statewide? How many people? But it can be approximate,
400.
about 400.
Mm-hmm.
Thank you. Any members, any other questions or comments? If not, we appreciate and acknowledge this report. Thank you. Members, we have one more item on our agenda today, which is an acknowledgement item of a request to the board for consideration for program funding for the fiscal year 2023-2024 from net lottery proceeds pursuant to TCA 45111 C2B. You have a memo in your packet, and for the record, I'm going to read it so that we can acknowledge it. We have a memo from Commissioner of Education Penny Swin pursuant to Tennessee Code 45111 C2B, which states prior to December 15th, appropriate state agencies shall submit to the funding board and to the governor their recommendations for other education programs and purposes consistent with Article, is that 11? Of the Tennessee Constitution, Section 5 of the Tennessee Constitution, The Department of Education requests the allotment of $23,000 from net lottery proceeds in FY 23-24 for Lottery Scholarship Day. These funds will support improvements and enhancements for educational programs and purposes, and such net proceeds shall be used to supplement, not supplant, non-lottery educational resources for educational programs and purposes. Your consideration, approval, acknowledgement of this request is appreciated. I think our role is to acknowledge this request and does not require a vote. So I've read the item into the record and it is acknowledged. Members, at this point in time, having concluded our work for today, I will move that we recess this meeting to reconvene November 28th, 2022 at 2:15 p.m. in this room for further consideration and hopefully adoption of the revenue estimates. That motion is properly seconded. Is there any question or discussion? If not, all those in favor of recessing until that appointed time, please respond by saying aye. Aye. Any opposed, like sign? We'll see you on November 28th. Have a great Thanksgiving in between. There's a turkey shortage out there. So go get them early. Thank you.